Good morning, everyone. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, the Fed's policy meeting concludes today and is the main event that markets will be watching. The central bank is set to release its latest interest rate decision as Fed Chair Powell tries to balance the inflation fight amid weakness in banking confidence. Markets are pricing in odds that the Fed will raise rates by a quarter point, although economists were expecting the Fed to make an even bigger rate move prior to the financial services turmoil that ensued. The decision will arrive at 2 p.m. Eastern Time, press conference to follow at 2:30 p.m. Second thing you need to know, Nike posts higher sales in the third quarter. The retail giant beat on top and bottom lines, but the company's margins, they remain a problem as it continues to deal with excess inventory. Its revenue rose 14% on the year, while its gross margins fell due to slower China sales, aggressive discounting activity, and higher production costs. And the third thing that you need to know this morning. Could this be the commencement of GameStop's comeback story? The stock is skyrocketing after the company posted its first quarterly profit in 2 years, surprising Wall Street. GameStop has been shoring up its online sales business and cutting costs ever since CEO Matt Furlong announced the company's turnaround plan in an effort to achieve profitability. Over the past year, the stock has fallen 25% after experiencing extreme highs and lows during the meme stock craze. Well, the Federal Reserve is set to release its pivotal interest rate decision. That's coming this afternoon with widespread uncertainty around what the central bank's move will be. Let's get to Yahoo Finance's Jen Schonberger with the latest. Jen.
Good morning, Brad. Fed officials convening the second day of their two-day policy meeting and what will be one of their toughest calls in years. Fed officials are having to balance the consequences of contagious bank runs with inflation that remains well above the central bank's 2% target. With a range of differing views around what the Fed will do, markets now largely expect the Fed to raise its benchmark interest rate by a quarter percentage point to a new range of 4.75% and 5%. The Fed has not had rates at 5% since May 2006. Before Silicon Valley Bank's failure 2 weeks ago, Fed Chair Powell had opened the door to what markets interpreted as a 50 basis point rate hike. And given strong CPI and jobs reports from February, that might have been on the table absent a banking crisis. Today, investors will receive officials' new projections for how high the central bank expects to raise rates ultimately. 3 weeks ago, Fed Chair Jay Powell was signaling rates would need to be raised higher than the range of 5 to 5.25% penciled in back in December. Now it's unclear given the banking issues juxtaposed with strong inflation and jobs data. We will also get new estimates for inflation, unemployment, and GDP. All eyes will be on Fed Chair Powell's press conference this afternoon to understand how the recent bank failures are impacting the Fed's views on inflation, the outlook for the economy, and ultimately setting interest rates. Brad, this decision coming down at 2 p.m. Eastern, followed by Fed Chair Powell's press conference at 2:30. Back to you.
We can't wait. Jen, thanks so much. You'll be tracking it, of course, for us. And you can read all about the Fed's tall task on fighting inflation while also facing a banking crisis in today's morning brief written by our Miles Udlin. That's up on the Yahoo Finance homepage. Joining us for more on the challenge here is John Stolfus, Oppenheimer Chief Investment Strategist. And, of course, there's the Fed challenge. And then there's all of our challenge, John, when it comes to trying to figure out how to play this. You titled a recent note, Riders on the Storm, as an illustration of it's not an easy environment right now to try to navigate. So I believe you're in the quarter point camp right now. How do you play it?
Right. Well, great to be on the show with you, Julie. It's been a while and great to be back. I've got to say that, we think the way to do it is stick with growthier value and GARP growth at this point, diversification across market capitalizations, and as well as, so you've got style, and then within the sectors, stay cyclicals over defensives. We think the defensive call is a little bit late. You want to be in cyclicals and in GARPier growth at this point with growthier value.
Okay, and so with all of that considered, I mean, Is it too late for someone to enact that play within their own kind of Fed playbook right now, or Fed adjacent playbook, knowing that the decision's coming later on today, and then now going out into the future, perhaps we'll get a little bit more of the inclination of what the Fed foresees and how they may continue to kind of parse through some of the range of impacts that we've seen, whether that be in banking or whether that be just on their benchmark targets?
Yeah, Brad, I think the challenge that the Fed is going into here really is one in which it needs to show that it is going to consistently deal with this inflation situation that has proved stickier, while at the same time showing a large amount of sensitivity to what the effects of its policy is to the economy as well as to the effect on inflation. There's this balance it has to do. Yes, it is a tightrope in essence, but the Fed, the most important thing here, I think, is with this confidence crisis that we had within banking, and we'll likely, still have to weather some aftermath of that storm over the course of the next few weeks or months. The reality is the most important thing is not what has brought stocks down once they've come down, but is what the response is. And thus far, that consortia response of the Fed, Treasury, the FDIC, as well as individual banks that have gotten involved in one case in particular, we've got to say it looks good, and we think that for investors, it really just depends upon their tolerance to risk. And are they traders? Are they intermediate or long-term investors? That's all up to them and their advisors. But we feel at this point confident that we are headed out of the woods, if not yet out of the woods. And we think the light at the end of the tunnel is not an oncoming locomotive, but is indeed sunlight.
And what are the conditions that sort of allow you to believe that? In other words, it sounds like you think that the worst of a banking crisis has now been contained, addressed by those various parties that you were talking about. It also sounds like you don't think the Fed is going to make a so-called mistake and drive the economy into a sharp recession. Is that fair to see it that way?
Yeah, we do think that Jerome Powell does not want to be remembered as having to take in draconian actions as Volcker had to, and we don't think he has to because he didn't have an Arthur Burns in front of him, and also doesn't want to be remembered as an Arthur Burns who doesn't address it. The Fed is highly communicative, and while it isn't infallible, it is highly capable of pivoting, as we've seen over the course of the last few years, when it does get behind the curve or gets ahead of it, as it did in 2015 to 2018, when it was hiking earlier on. So we just think that the Fed is doing the right thing. They're experienced, but it doesn't mean that we won't experience volatility. It's just that it's digestible by the markets, at least, since the lows of October last year. Through now, it's been pretty steady, the positive sectors that have been showing good performance, and it shows a confidence. It's a lot more than blind by the dip kind of action by investors.
John, we're showing our viewers the Fed rate predictions from each bank this morning, and even in my notes, I had written these down, put kind of an LOL next to Nomura, really standing out there. But I mean, at the end of the day, if we were to see some type of major pause or a cut even, what do you think the Fed would also have to say in tandem with that?
I think it would have to say that it was doing this as an effort to stem any kind of situation that it might feel could come up. A lot of times when you have a crisis like this, very much like in a hurricane, the next day the sun comes up, it's a beautiful day, but if you go in the water, you have to be careful because you might get hit in the head by a 2x4. It'd have to show a relaxed kind of way to explain it. But the market, I don't think, would be very happy with a pause or a cut. But I think 25 bips, I think, when we move towards greater stability, with a realization that the end of free money is actually a good thing, in that it will bring, hopefully, the markets back more to be attuned to developments on fundamentals than on the latest meme idea or crypto coin, you know.
There's another, to sort of circle back around to strategy where we began this conversation, John. One of the areas you like, and you talked about cyclicals, one of the areas you like is technology, established technology companies. And it has been really fascinating to see tech come back, right, in this environment and seen almost as an area of safety. What do you make of that?
Well, I think, you know, I could try to downplay any kind of safety zone on anything. I think that this SVB bank kind of showed that even treasuries aren't safe. They forgot Finance 101, that you have to watch the maturities that you own and will look towards liquidity in a rising interest rate market. Apparently, that's one of the problems there. But so I would certainly place that with technology. You've got to watch it. But the idea, I think, that the market has been saying is just it was desperately oversold. The problem with the way technology was sold in 2022 is it lumped both established companies as well as long duration technology companies that may not see positive cash flow for years of profitability in with well-established companies that we as consumers and business people depend upon every day. And while we may not wait for every upgrade with bated breath, we most certainly need those upgrades, and we're looking for the latest products to help us work more efficiently in a very fast-moving environment.
Well, you certainly have us on the end of our seats waiting with bated breath for all of your notes as well. John, we appreciate the conversation as always. John Stolfus, who is the Oppenheimer Chief Investment Strategist. Thanks for your time this morning. Also, everyone, Nike, those Q3 earnings, they came out yesterday and they boasted stronger than expected revenue, but shares of the footwear giant on the decline this morning. Joining us to dive deeper is Jim Duffy, Stifel Managing Director in the consumer and retail sector. Jim, I want to get your broad read here, but perhaps you could zero in on the margins here for Nike and the fact that even I, as many other consumers, buyers of their products perhaps, were really keen to some of these massive discounts that were coming and had taken place in this most recent quarter and how that ultimately impacted them.
Sure. Good morning, Brad. Good morning, Julie. Thanks for having me. So Nike has had a massive inventory problem and they're working through that. Most importantly for the quarter, they made very good progress. That came at the expense of margins. Margins were a little bit light in the quarter, about 30 basis points. The guidance for the fiscal fourth quarter implied the full year margin guide towards the lower end of their prior range. The good news, however, is they are making good progress working through the inventories. Stifel's view here is that the reason to own this stock is for earnings power in fiscal 24 plus, to the extent that they can work through that inventory situation, get in a clean position into fiscal 24. We think there's a lot of margin recapture opportunity. Effectively, they've got about 350 basis points of supply chain costs and promotion, which can be a recapture opportunity in fiscal 24 plus. So that's really where we're focused.
And Jim, you know, to work down that inventory, as Brad alluded to, they are going to continue to have to do some discounting. Do we have a good feel for, outside of the core product, how much discounting, how much of their merchandise is discounting as they try to work down that inventory? In other words, before we get to 24 and that uptick in profitability, we're going to have a little bit of a compression here in those margins.
True. Well, you've got one quarter left. Remember, Nike's on a May fiscal year, right? And so we're soon to be rounding the corner into fiscal 24. Julie, let me frame it this way. So indeed, promotion did benefit the sales rate in the quarter. We saw North America and EMEA both grow at better than 25% rates. But encouraging to us, the unit growth was up 10%, but they also saw growth in ASP. So going along with that promotion is full price volume, which is driving the sales growth. So a lot of good indicators on brand vitality.
There's lots of other stuff to ask about Nike specifically, including China, but I do want to broaden it out for just a second here because of this discounting. If a brand like Nike, which I think has such high brand value, brand recognition, et cetera, is doing this discounting, what's the read through for the rest of retail and particularly athletic apparel and footwear?
It's a a great question, Julie. Given Nike's scale, I often say when Nike gets a cold, the rest of the industry gets the flu. So Nike promoting moving through this inventory has put pressure on the rest of the industry, and you've seen a promotional backdrop across the footwear and apparel landscape, but predominantly the apparel landscape where Nike's inventory challenges were more exaggerated. We view the report yesterday and their commentary about inventory control by the end of the fiscal year to be a healthy indicator for the industry as a whole. Nike getting clean on inventory is going to mean a less promotional backdrop, and that should benefit all players.
You know, one thing that we've heard from the CEOs of Brooks Running as well as New Balance's CEO as well is that running is recession resistant, Jim. And for Nike, they talked about on the call, you know, them saying, again, running is at the heart of Nike, basketball being the soul. But for running and the recession resistance that these brands have all talked about, is there a clear categorical winner within this footwear industry for running as we kind of look at the consumer and try to figure out where they may be looking still for discounts, for sales, even as Nike is trying to hold prices at, you know, 65% of their inventory being sold at full price?
Yeah, we're actually seeing quite strong pricing trends in the running category. A couple of brands that have been gaining share and we're recommending both stocks. On Running, who reported yesterday, had 92% growth in their fiscal fourth quarter. They got into low 60s growth in their fiscal first quarter. Very strong brand momentum there. Their premium price brand have been raising the pricing envelope for all brands in the category. We're also recommending Deckers Outdoors, which owns the Hoka brand. Hoka also seeing better than 50% growth rates. So a lot of strong trends in that running category. You are seeing some share shifts within the category. Some of the legacy brands are advocating share to Hoka and On, and Nike continues to make forward progress in running, and so gaining share relative to the market.
Yeah, it's amazing how we've seen On and Hoka just explode in popularity over the last couple of years. Jim, finally, did want to turn it to China, and where we did see Nike make some progress. What do you think specifically in that region does Nike look like in the coming year?
Yeah, you bet. So Stifel has a consultant that we've been working with in China to give us perspective on the sportswear market. We've been hosting quarterly conference calls with this consultant. December 8th was the change of policy in China. He had a massive COVID outbreak in December that carried into January. Nike spoke to December trends being down year to year, a rebound in January, inflecting to growth. And then importantly, in February, they saw acceleration on that, despite what was more difficult compares with the timing of Lunar New Year a year ago. So the market is moving the right direction, and we're optimistic about what a recovery in China can mean for Nike and for other brands. Specific to Nike, we estimate that peak to trough, the earnings hit from a fall off in the China business was 50 cents to the earnings power, and that's the recapture opportunity as that business comes back.
We'll be watching it. Jim, thanks for the intel. Jim Duffy, Stifel Managing Director. Appreciate your time this morning. Well, GameStop shares are on the rise in pre-market trading after yesterday's surprisingly positive earnings. They're not just on the rise, they're exploding higher. They're up 51%. The company reported its first quarterly profit in 2 years, beating analyst estimates for revenue. The upward momentum also boosted AMC and Bed Bath & Beyond. There's a lot of meme action happening this morning. We'll have more details on that and the opening bell. We're coming up on the opening bell in just a bit. Let's talk about some movers. Here's a very movie mover today. That's GameStop. It's surging this morning after the video game retailer exceeded earnings estimates and reported its first profitable quarter in 2 years. And this was a surprise. The company's net income, $48.2 million. It had a loss just about triple that a year earlier. Net sales, $2.23 billion, which also beat estimates here, even though they were lower year over year. I mean, you know, as our afternoon team talked about, I think with Ihor Dusanowski yesterday, this is a stock that has very high short interest.
Yeah.
And so when you get a bit of positive news, you get a short squeeze, which appears to be at least part of the picture today.
Yeah, one thing that I did want to call out here, and kind of just a nod of confidence on how they are kind of reattaching themselves perhaps to some of the fundamentals. Inventory improvement was significant, $682.9 million at the close of the period. You compare that to what they had at the close of the prior year's fourth quarter of $915 million there. So trying to churn through some of that inventory. They have such a focus on really getting this back to a healthy position. And so continuing to see that improve, that's one huge thing. Another thing is what they've seen in terms of the digital side of the business and continuing to invest further into that. We know this was a big task item and prioritization, even as Ryan Cohen annexed himself and his inclinations to move this towards a more digital savvy or even digital first to the extent that they can with the brick and mortar footprint that they have type of brand. And I think some of those efforts are really starting to pay off now too.
They are. And yet this company, which has been sort of notorious for giving short conference calls, for not giving a lot of guidance, still isn't giving guidance. The company's CFO said on the call that it's a much healthier business than it was at the start of 2021 and that they have a path to full year profitability, but they didn't give a specific outlook for the full year. So just something to note there when we're talking about GameStop. But, you know, as is frequently the case, when you get one meme stock doing well,
right,
you get a lot of meme stocks doing well. And that seems to be the case again today. You see there some of the other stocks moving higher. In pre-market trading, Bed Bath & Beyond and AMC, sort of the more classic memes. There's actual news on Virgin Orbit, which we'll get to in a second, but we are seeing this sort of ripple effect.
Yeah, a little bit of a move in sympathy, at least as some of the gamers are celebrating here on the day, or the shoppers in GameStop, or just the people who've been holding on for dear life for quite some time, and the longer ebbs and flows of the stock price gyrations. But at the end of the day, too, going forward, I think looking at and keeping tabs on Bed Bath & Beyond, keeping tabs on AMC, those are still companies that are trying to reattach themselves to fundamentals as well. AMC just came off of a year where there was a massive title and content blitz just to try and get people back into the theaters. And so if it wasn't last year, then what does this year hold for them, knowing that some of those dollars might tighten even more given the expensiveness or the expense that a movie theater experience is? And then separately in Bed Bath & Beyond, you know, the turmoil that's taking place there.
Yeah, I've got the heat map up on the Wi-Fi Interactive of all of the memes here. And GameStop, as we mentioned, the stock is up some 54% in pre-market. Carvana also higher on a new debt offering, which we're going to talk, or I guess it's paying down some of its debt. We're going to talk about that a little bit later. All of these on the upper left of your screen. AMC, Bed Bath & Beyond up this morning at about 8% here. It was a little change in yesterday's trading. So that's sort of the bigger picture on the memes. To bring it back to another stock that I think is sort of getting memey, which is Virgin Orbit, which actually has some news today. The company, remember, effectively shut down last week and now says it is targeting an incremental resumption of operations that they're going to start Thursday of this week. They're going to return some of their team to work here. Reuters also reporting the company is working on a $200 million infusion from a venture capital investor, Matthew Brown. So that seems to be helping. But again here, you have to consider the short interest in pretty much any of these very small cap, meme kind of names as playing a role when you've got this kind of upside.
Yeah, for Virgin Orbit, the story has been and continues to be the headwinds that they face as a result of their own launches and those launches not going successfully and how costly those launches are. So impacting the amount of cash that they are able to still deploy just to operate on a day in, day out basis and make sure that they can pay people at the end of the day. And so within that, I think it's really just a matter of how they are able to shore up capital in this near-term period of time and get confidence from any lender that would be able to give them that infusion of capital that they're going to be able to be paid back one day. And the, of course, alternative, as we have seen over the past week, is far more dire when you do have a company that essentially says, all right, yeah, we got to shut down the operation just to figure out how we can go on existing. But it's a significant mission that the company holds on to, and trying to make sure that within all of the launches and the satellites that are a larger component in the payload that they're trying to put into orbit as well. I mean, it could pay off, but it's just a matter of when, how, and will they have enough capital and cash to deploy towards just that operation and making sure that it's sustainable over a long-term period of time to get to profitability.
Well, today, the stock's going to the moon.
No.
Sorry. Kinda.
As they say, get to banks in our ears. Guys, let's check in the latest market action in the banking sector as well. Investors are looking ahead to today's Fed decision, and we've got even more of this movement that's taking place in the regional banks. You flagged PacWest Bancorp as well, and we're seeing that move lower here pre-market by about 8%.
Yeah, although the company said it secured some cash from a financing facility, $1.4 billion in cash. It's got a financing facility from Atlas SP Partners. Maybe what's weighing on the bank is that at the same time it's making an announcement that its deposits fell by 20%, and it had been trying separately to raise capital in different ways, and that is not working out. So I suspect that is what's going on here, and why the stock is trading so much lower in pre-market trading, despite raising some capital or getting financing in a different way here. Yeah,
$3.7 billion borrowed from the Federal Home Loan Bank System, and then $10.5 billion from the Federal Reserve's discount window, plus $2.1 billion in Bank Term Funding Program. That was as of March 20. And so the investors are going to continue to have to look at the injection of capital that needs to come post textbook bank run for not just First Republic that we had seen, for PacWest, and then additionally for Silicon Valley Bank that led to its own collapse. These are bank runs where you see an extreme and volatile volume of the amount of deposits that come forward, and then essentially thereafter it's just a matter of, okay, do we have enough cash for our day-to-day, any type of deposits or withdrawals that we might be exposed to as well, and being able to cash in on those.
Right, and part of the question is, where is that money going, right? There's some concern. The guests we've talked to are saying if it goes to bigger banks, then are those bigger banks even bigger, and is that more of a systemic risk? But some of it must undoubtedly be flowing to other small banks as well. Again, I'm looking at the Wi-Fi Interactive, and PacWest is now down some 47% year to date. If you look at that, and some of the other regional banks have just been knocked around pretty acutely. That said, if you look at other regional banks this morning, they are not all trading lower. So that's perhaps encouraging here, that you don't have this wholesale selling that we were seeing earlier in this crisis. There you've got the opening bell on Wall Street as we check the markets, sponsored by Tasty Trade on this Fed day. On Fed days, you tend to see a little bit of pause, right? Not a lot of action in the markets until we hear from the Federal Reserve. And as we look at the opening bell and where we are trading here today, that is the case once again, right? We've got not much change here. The S&P and the Nasdaq, well, I was going to say they were both lower, but now the S&P is lower again. They're bouncing around the unchanged line is basically how we can put it here. And that's because for the first time in a while, there is some actual suspense around what the Federal Reserve will do. It does seem consensus has coalesced around a quarter-point rate hike today, being announced later today. However, there is still, the chance that something could be said in the press conference that could affect stocks in an unexpected way. There's always that chance, but today there seems to be, Brad, more of that chance than usual.
Yeah, bouncing around. Of course, a technical term for the markets coined by NERD and Rihanna. Dow Jones Industrial Average, you're seeing that flat as of right now here. Still holding on to some gains just ever so slightly over the past 3 days. Still higher by about 2.25%, just a little bit more than that. The Nasdaq Composite, you're seeing that flat, but to the downside for the tech-heavy average this morning, out of the gate down by about 6 points. But over the past 3 days, in context here, still higher by about 1.9%. And the S&P 500, you're seeing that here on this hump day, up over the past 3 days, but here on this hump day. It is flat to the downside by about 0.1%. We'll round that off too. Also want to take a look at some of the sector activity that we're seeing out of the gate this morning. 11 S&P 500 sectors. You know what the deal is, folks. We've got them pulled up on your screen here. XLRE pulling up the caboose. That's down by about 1.2%. But hey, look no further than some staples. It seems like there might be a little bit of a retreat to those staples this morning. At least it's up by about 0.1% and is leading the charge here among the S&P 500 11 sectors, but more laggards than gainers. Overall, the index is lower. Taking a look at some of the tech moves that we're seeing out of the gate here and focusing in on some of the mega cap tech names, Microsoft, Alphabet, both of those lower here to start off the day. Alphabet down by a little bit more than 1%. Apple holding on to slight gains. That is up by about 0.1%. I didn't touch anything but the screen changed, so we're just going to go back to it for a hot second here and take a look at Tesla and how that's doing on the day. And here's why: 0.6% in the move higher here on the day. But I'd also been tracking this one yesterday for a little bit. Let's just see how it's performing on the week. Over the past 3 days, up by about 10%. Pretty significant move that we're seeing there on Tesla, even as Elon continues to tweet about his own economic inclinations or projections. And so we'll continue to watch that, as well as Meta. Meta's been seeing an interesting move on the week. Of course, you had that call yesterday that really gave Reels a little bit of a sentiment boost there, but ultimately over the past 3 days up by about 4% for Meta Platforms, Facebook Meta, whatever you're calling them at home. Call them up this week.
Whatever we're calling it now, exactly. It looks like KeyBank also turning bullish on Meta shares this morning, and so that doesn't hurt matters. Seems like a lot of people are there's some positive chatter. Not so positive, however, on our next mover, and that's Luminar. Shares are sliding after Goldman Sachs downgraded the tech company to a sell, saying it's fully valued and it's going to face greater margin pressure. Luminar shares down some 7% here this morning. The analyst over there, Mark Delaney, saying that they can continue to see Luminar as one of a handful of leaders in the very competitive LiDAR industry. That's a quote from the note here. However, it really has to do with the company's margin outlook, revenue per vehicle, and also they're looking at what has happened with the stock and that the stock is now more fully valued. So all of that affecting the shares here this morning. I hadn't had a chance yet to check to see if there are any other sells on Luminar, but it's interesting to get this kind of a call on the company.
Yeah, within the note.
It's the only one. It's the only one. Only sell on the company.
Only sell. Okay, singular. Lone wolf out there, or lone bear. But Luminar attributing this higher average selling price in part to software, the note had also said, and they also believe it's got some opportunities in that regard. The market for the software is highly competitive, and they also believe underlying hardware gross margins, tailwinds from software, it could be lower than the company targets there. And so that is within the note, but they ultimately think that the current valuation is expensive right now.
Yeah, the stock is up, even with today's drop, 56% this year.
Interesting.
I mean, it's down over the last year, I believe, like so many of these tech
51, I
stocks.
think.
Yeah, 51% or so.
Yeah.
And then has had this rebound. So we'll see.
A lot to track in lasers, in the world of lasers, everyone. Also coming up, pause for thought. We're watching shares of Petco after a rough fourth quarter earnings. Oh yeah, they're all in there. We'll speak with its CEO in the next hour. Are investors barking up the wrong or right tree here? We're taking a look at shares. They're down by about 8%. But on the other side of the break, Yahoo Finance's Jared Blickery going to break down the latest market action ahead of the Fed decision at 2 p.m. Eastern Time. That's coming up on the other side of the short break. Welcome back to Yahoo Finance Live this morning, everyone. Taking a look at the major averages, we are down across the board, but we've been kind of flippity-flopping, waffling here on this Wednesday. Let's get on over to Jared Blickery, back live and live in color at the Wi-Fi Interactive.
Here for the big show today, and while I was gone, not much happening this morning, but let's check out what has happened in my absence. This is over the last 5 days. I was last here Thursday afternoon. It's been up 3.5%. That is the Nasdaq. Dow, which has been lagging this year, that is up 2%, but I think investors will take that. And let me just show you what the sector action is today, and then I'll close on some longer term outlooks here. Now, tech is in the green here, but just barely 14 basis points. Materials, staples, healthcare also slightly in the green. Real estate really taking it. That's down over almost 1.5%, followed by utilities there. So a little bit, some of the defensive sectors in the rear might be what you would expect for this day, but not seeing any huge trends. NVIDIA up 1.5%, Tesla up 1%. But let me go back to the S&P 500 here and also take a look at, here's a 3-month chart. Now, let me just put a 1 year, and you can see over the last year, basically not a whole lot has happened. In fact, that goes back to the beginning of Jay Powell's efforts all the way towards the end of Q1 last year. But I want to show something that has developed in the market. This comes via Morgan Stanley. Here's a little note. 5 things that happen when the S&P 5, or excuse me, 5 things that happen when these 5 things are happening. Okay, so SPX, that's S&P 500 forward earnings, those are declining. That means that expectations of future earnings are going down. Yield curve has been inverted since last year. That's one of the things. Unemployment below average. That means that the economy is still primed, yet manufacturing PMI is going below 50. That means that we're seeing cracks in the manufacturing sector, plus 40% of banks tightening lending standards. So all of this points to the situation where we are now, that we still have a robust economy that is on the precipice of cracking. And when all of those 5 things are in effect, we usually, 6 months out, we usually have a decline of 4.5% in equities prices. So just something to consider there, guys.
We'll definitely consider it. But Jared, I got to ask you something else very important. Forget about all this market stuff. You are one of the privileged few to have attended the kickoff of the Taylor Swift tour in Arizona. Any impressions, any teasers for those who are hoping to go?
Absolutely amazing. You're not going to believe it unless you see it yourself. It is probably the most elaborate, incredible stadium show I've ever seen. Gail was there, Paramore opened up. I will say, heading into the concert though, prices were crashing. I was fortunate.
Really?
I was fortunate in that my overpriced tickets were never delivered to me. I was able to get a refund and repurchase tickets on the cheap that were much better in terms of seats.
Holy moly,
so
that is some news you can use right there.
I know, there are deals out there, and is that a symptom of the economy, that there's not as much play money out there and that these ticket prices are crashing? I don't know, but there are some deals out there. So
you flew out there, and your original tickets were never delivered to you.
When I landed on Friday, I had no tickets.
What?
So thank you, StubHub. But I was able to get one up, I would like to think, by getting better tickets at a better price.
So you got them for below face, or was there even face? Is face totally meaningless when it comes to
I don't even know. There is still a premium, and you have to pay these fees, like the StubHub fees are outrageous. But I can tell you that the tickets were selling for a multiple. The ones I eventually got were selling for a multiple of the price that I got them at.
We should blow out the next block. We can continue to talk about this. Yeah.
Jared, thank you. Forget about the Fed. Coming up, why our next guest says the recession in the U.S. could be postponed for a few years. We'll speak with FundStrat's Mark Newton, check on some more charts. That's next.
Let's take a look at First Republic.
Now the attention is shifted to Credit Suisse.
With all the news that's ensued around the banking crisis, as some have called it, there is one more term that has made its own resurgence, and that is moral hazard. Moral hazard is essentially when one entity engages in an activity of elevated or heightened risk, knowing that another party or entity is their safety net. So for instance, in my own consumption patterns in the past, I have been known to be a buyer of LL Bean boots. I've got the receipts, folks. And one of the policies was I bought a pair of LL Bean boots knowing that they had such a great return policy that I could go back at any time with no explanation and had some damaged boots and said, hey, you know what? I need some new boots because your policy said that I could do this. And so that is me exhibiting moral hazard. I've engaged in the heightened or elevated risky activity, but I knew that there was a policy to be my safety net and I could return those boots. Now, that LL Bean policy has since changed, and thank goodness for their own business. But at the end of the day, this still persists within banks who take on elevated risk in their lending practices or in the investments that they may make, knowing that they are so entrenched or their businesses touch so many parts of the economy that there will be other entities that step in to be their backstop or their safety net.
Investors are now widely expecting the Federal Reserve to lift rates by 25 basis points or a quarter percentage point at its Federal Open Market Committee meeting. Many now wonder what implications that could have for markets as well as the economy in the wake of Silicon Valley Bank's collapse, and whether a hike during this financial turmoil increases the odds of a recession. Joining now for more on what the market's technicals are suggesting is Fundstrat Global Advisors Global Head of Technical Strategy, Mark Newton. Mark, thank you so much for being here. You definitely have brought us some charts that we should be watching here. Where do you want to start? What's the sort of foremost in your mind as we go into the Fed meeting?
Well, look, Fed days are always extraordinarily important, and which is a lot less than we've seen all year long. And also we know that really, the average movement is about 1.9%. Obviously Powell's comments are increasingly important in really helping to shape investors' expectations. And so, that started during their Bernanke term back in 2011. So, obviously, a lot of volatility. We've had a big rally, about 200-point rally in the S&P since March the 13th. S&P is now up to what I believe is very important, sort of make or break levels for the market. Big move in technology. That's really been the area that's carried, the majority of the market. And of course, the most important being 27%. So it's going to be important to really see if the market can really follow through on this and see other sectors really start to help to carry the load outside of just technology.
Okay, and so we don't want to kind of belabor some of the charts that you've been looking at and the technical analysis here. And so you believe that stocks could take off this year, but within this, of course, we have to factor in a few things, one of which you were just walking through, falling interest rate expectations being a positive there. But then what else would you be keeping an eye on here?
Well, look, I think the consensus is right now that the market has it wrong, and that's really interesting. Everybody is really talking the same playbook that, earnings revisions have to continue to drop, that the Fed is going to hike us into a recession. There's a lot of doom and gloom for probably a lot of the right reasons. However, as we heard from Soros's famous protege, Druckenmiller, the economy of the stock market is the best economist I know. So, we really should be concentrating on levels of sentiment and what sentiment is teaching us about what investors think, rather than really debating whether it's going to be 25 basis points or zero. The labor market remains in very good shape. This is a very different economy than any of us have been used to in a long time. So we can't really use the same playbook to say that, we're going to have a recession or not. And you really have to follow really what the market's telling us. And the market has had a very good start to the year. Now we've had about a 6% drop from early February. However, technology has outperformed any other sector over the last month. It's been the number one sector. And we're starting to see some evidence of financials now. The banks are stabilizing. Healthcare, I sent you a chart on healthcare. I think that's important. That's the second largest group within the S&P. And now that's starting to show evidence of trying to stabilize and move higher. So this is a a chart really of equal-weighted healthcare versus the equal-weighted S&P. So when you see these stocks within groups like medical devices and biotech starting to gain ground, that's a really important thing to concentrate on for investors, because that's a very, a very heavy sector within the S&P outside of technology.
And, we had up a chart of the S&P 500 year to date with some of your technical mapping on there. What can you walk us through what these lines are and what we should be watching, what all of this indicates?
Well, those of us that use technical analysis, we're apt to really draw trend lines connecting, the highest high to the high that precedes a low. Bottom line, you want to get an understanding of trends. Are the trends moving, up, down, or sideways? And so, the market's had a great bounce since last October, but recently we've been in consolidation mode since the beginning of February. So that upper line really is what a lot of investors consider to be trend line resistance. And in order to expect that this rally is going to continue, we actually need to get above that. That would provide, some firepower, some energy for investors to either climb on board or for shorts to be stopped out. And that will allow, the market continue to rise. But normally, having a sharp 200-point rally into a very important level, that's normally a time also when you could see profit taking and see a pullback. So, really a make or break, as I discussed, for regards to the S&P at this level, because we've had a decent bounce. And now, the key is, can financials and the banks continue to, bounce at this point? And we've seen some evidence this morning that a few of them are under pressure yet again. And can healthcare continue? So technology being 28%, financials and healthcare are both about 12%. So that's over 50% of the market right there in just those three sectors. So incredibly important for investors to really understand the sector rotation and what's happening.
Mark, you also have a chart particularly tracking the 100-day moving average of Bitcoin. And Bitcoin, we know, has kind of broken through some of those resistance levels. And right now we're kind of sitting and watching and waiting to see if it will hold or hit above 30,000 and then maintain that level. What most notably, especially for those who would say, all right, well, technical analysis, when we have a different set of parameters than perhaps we've ever seen before, what is the case for the technical analysis, and especially for something that is as volatile as cryptocurrency and Bitcoin?
Well, Brad, I would first of all say that technical analysis is always useful for all investors to have an understanding of trend, and particularly with regards to cryptocurrencies, where fundamentals might be less relevant to how the price moves on a day-to-day basis. Knowing, how price starts to move and how it accelerates, and watching things like momentum and breadth and sentiment are very important. So look, Bitcoin has rallied. It's almost doubled from last November's lows. It's been up about nearly 10,000 points just since March 13th. So that certainly is causing investors to suddenly pay attention at a time when maybe they couldn't care less a few months ago. I would argue that the area right near 28, 29,000 is very important. We've had a very good lift off the lows, but it's gotten a bit overbought. And you look at just daily charts that really show the dramatic surge we've seen in Bitcoin, or we concentrate on just a weekly chart to show that 100-week moving average. I'm looking at things like Ethereum that are rapidly starting to maybe, come back into play and gain ground on Bitcoin after such a big move in Bitcoin in a short period of time.
Mark, good to see you. Thanks for this technical analysis, as you say, useful for many investors. FundStrat's Global Head of Technical Strategy, Mark Newton. Thanks. Coming up, the aftermath of SVB's collapse. How do we get here and what's next? We'll have a panel of experts to break it down in the next hour. Stay tuned. NVIDIA is ramping up its push into artificial intelligence as the company laid out plans at its annual software developer conference. It's called GTC, and it's trying to make supercomputers used to develop AI technologies. I got the chance to talk with NVIDIA's Vice President of Enterprise Computing, Manuvir Das, yesterday. Here's what he had to say on the opportunity for NVIDIA in AI.
NVIDIA for years now has worked with companies to adopt a variety of use cases for AI that are specific to their business. But, every company has to get bought in. I think what's happened with ChatGPT and generative AI is we have come to the moment there's a broad horizontal use case that every company, no matter what industry it's in, can see the value of that. And I think this is what is really going to make the adoption of AI take off. And obviously, NVIDIA is very excited to be part of that.
NVIDIA has been talking about AI for a while now, but I think it's interesting that ChatGPT has sort of tipped the public consciousness, not just in consumer, but also in enterprise, and sort of opened the door for companies like NVIDIA or like Adobe, who we spoke to yesterday, to then, sell some of those products to their clients.
That's exactly what I wrote down. Adobe, Shutterstock, two of those instances where generative AI, especially within images, can serve a massive purpose for the broader marketing clouds and the creative suites that they offer right now. And so for NVIDIA and what they're doing with DGX Cloud, layering that into the different data centers that they operate, and for IBM, which is one of the more historical OGs within artificial intelligence as we had known it, especially in the cybersecurity landscape, there is still a ton that Big Blue can perhaps do to widen their own portfolio or client base, given what they have already had, and just walking into meetings saying, hey, we've been a categorical leader in this for about 2 decades now. So for the newest advancements in technology, I think on the generative AI front of that, it's been interesting to hear about where this will begin to become monetized for an Adobe, a Shutterstock, so forth.
All these companies want a piece, for sure. We're going to talk more about NVIDIA's strategy with respect to all of that and have a broader conversation about the chip industry. That's with Jensen Huang. I'll be talking with him, so will our Dan Halley. We're going to have that conversation for you at 4:10 p.m. Eastern today. Be sure to tune in then. Yahoo Finance is going to get a chance to talk to him about all of these issues.
Always got a solid leather jacket on, Jensen.
Yes, that's the signature look.
Yes, indeed. Guys, coming up, where will rates go next? Big question of the day, the week, you know it. We're going to speak with BlackRock's Rick Reeder on what to expect from the Fed decision, 2 p.m. Eastern Time. That's next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. Let's check in on the market action as traders await the Federal Reserve's latest interest rate decision. We got markets that are not much changed today, and if you look at the sector breakdown here, real estate is the real standout to the downside, the biggest move by far that we are seeing in the major averages today in terms of the sectors in the S&P. Utilities also on the move, but the XLRE, that's the ETF that tracks real estate, down 1.75% today. And of course, we are also continuing to watch what's going on with the banks today as we watch attempts to stabilize the banking system, right? We got that report that PacWest was trying to tap into some new financing, continuing efforts to shore up First Republic as well. Here are some of the bigger banks here, and we don't see much move in them today, really, if you look at them, except for UBS, which it looks like is down by a little more than 3%. But if you look at some of the other regional banks that we have been watching, we continue to track those very closely. Just going to take it to an equal weight view here so we can see things a little more clearly. PacWest, which I mentioned, down some 4% in today's session, as it also talked about 20% of its deposits going out the door as a result of everything going on. And then First Republic is down about 3% or so today. We'll see how directly, or if at all, Jay Powell of the Fed addresses these issues today. There's one more thing I wanted to check on, and that's what's going on in the bond market. We're not seeing any change right now in the 10-year yield, around 3.6%. But you see on this one-year chart, the sort of up and down movement that we've seen this year as people try to game out what the Fed is going to do. So let's talk more about that challenge that the Federal Reserve has today as Chair Powell gears up to deliver the decision on rate hikes. And really, there are sort of three masters, if you will, for the Fed right now. There is stability, pricing, keeping prices stable. There is keeping employment full. And now also there is ensuring potential stability in the financial system. Rick Reeder is with us, BlackRock Global Fixed Income Chief Investment Officer. Of those three masters, which one or ones is the Fed going to serve today, Rick?
You're exactly right. Those are, two are directly. The two primary mandates are price stability, full employment. And I would say today, full employment is pretty much where it needs to be. But the indirect one is financial stability. And listen, I think what they're going to do is going to try and bifurcate the discussion, meaning you use interest rate to deal with inflation. And so my sense is you get a 25 basis point rate hike today, but it's pretty close. But I think you get a 25 basis point rate hike. And I think the Fed continues on its mission of we need to bring down what is elevated inflation. And quite frankly, the momentum of it hasn't been working in the favor of the Fed at this point. So I think that's what they use rate for. I think the commentary and I think the discussion around the terminal rate, which I think is more important, that I think is going to go to 5.25, 5.5, or be implied as such, then I think that is you're going to pause and stop raising rates over the next couple of meetings. And I think they'll talk about the incredible amount of liquidity they put into the system. And by the way, the Fed's balance sheet has grown $300 billion since March 1st, big number. And so I think they're going to try and bifurcate it, let the balance sheet grow, provide liquidity, deal with financial stability, and then use the interest rate mechanism to try and bring down this stubborn inflation.
Rick, that started to get into my next question, which was really around the terminal rate. And in that bifurcated conversation, even if we did see 25 basis points today, could they effectively communicate a pause by saying they were going to keep the terminal rate at a specific level or not budge that?
So it's a great question. Listen, by the way, I don't think the delta to the markets on you go 25 or pause today, I don't think is that significant, because I think if you go 25 and you say, gosh, we're getting to the place where we're going to start to pause and get to that terminal rate, or you pause and you say, gosh, we still want to get to that 5.25, 5.5, which is the way I think they're going. So I don't think that is that significant a magnitude. And listen, I think the idea that we've reached a rate threshold and to let long and variable lag work through the system, I think that's going to be really important. Listen, I think, I hear it all the time with commentators who describe it as, gosh, the Fed can just keep going to fight inflation. You see what plays out in the system. And I think we're seeing that today. Financial stability, financial transmission becomes really shocked in situations like this. And so I think the Fed will talk about that. I think it would be surprising if Chair Powell didn't reference it. and talk about the go forward and around, we don't need to raise rates that much further. And we're going to make sure that we've provided enough liquidity to the system to withstand some of these shocks.
Let's talk about those shocks for a moment, though, Rick, because does it feel like they're contained at this point? In other words, everybody's, well, not everybody, but they're initially, of course, after the collapse of SVB, there was a lot of sort of hair on fire running around, particularly, I would say, on the West Coast, right? It feels like in the markets and elsewhere, things have calmed down to a considerable extent. So is there even that urgency there for the Fed to do anything about this? Is it sort of fixed itself?
So, Julia, first of all, I find that markets can be incredibly fickle. And so what they do one day, I'd say this weekend, markets aren't open the weekend, but there was a lot of sweaty palms on the weekend as well, and a lot of work done that portfolio managers et al. Were doing over the weekend. So, listen, I think there is a structural issue today that is manifesting itself around. There's a lot of commercial real estate that's been financed over the last few years. When you raise rates this quickly, the interest-sensitive parts of the economy, and particularly where there's financing or leverage attached to it, then that's where you create stress. That's not going away tomorrow. And so you described, some of the institutions that have. It's not just deposit outflow, but it's the fact that a lot of these rates were locked in 2020, 2021, when rates were significantly lower. And there's a structural problem with the interest-sensitive parts of the economy, particularly around real estate and most intensely commercial real estate. So that's it's pretty hard to fix all of that very quickly. Again, guarantees on deposits is a powerful way to slow that down. But by the way, you can invest in T-bills today. You can invest in buying things like commercial paper at behind 5% at 5.25%, 5.5%. There's a lot of alternatives to deposits. And that at today's market prices are pretty attractive. So you've got a structural dynamic in the system that's going to take some time to work through.
Yeah, Torsten Slok of Apollo noting recently the increase in money market funds and people putting money into that as an alternative as well. As I noted a few moments ago, the XLRE of real estate stocks are doing poorly in particular today, perhaps reflecting some of what you're talking about with commercial real estate concerns. But is that a systemic risk, do you think? The idea of that repricing of some of these commercial real estate holdings?
So if you go back to 07, 08, you think about the size of the housing market relative to, roughly 3/4 of the wealth in the country by people is in the housing market. Commercial real estate is not nearly as intense to create what is a systemic problem. However, you get isolated pockets that can lead to contagion risk. Listen, I think, what we talked about is, you think about all these markets, and you think about the next, what happened the last 5 to 10 years of investing when rates are at 0 or 1% or very low and negative in Europe. You have a dynamic where you can finance things, commercial real estate, private equity, et cetera, and it's very, very attractive to do it. When you lift the risk-free rate and keep it at this level, all of a sudden those assets become very hard to roll over your financing. And that becomes like, where do you invest today? Gosh, it's pretty darn attractive to buy. You don't have to take a lot of liquidity risk, beta risk. You can invest in things at 5, 5.25, 5.5 that don't have a lot of risk. That changes the whole paradigm of real estate, mezzanine financing, equity financing. By the way, the stock market, I think the stock market's just, and we talked about it on your show in the last few months, it's just okay. If you can create the risk-free rate, most people's return targets. Gosh, if I said to you, I can get you a 5 to 6 with complete safety, a lot of people would sign up for that. It means, how much equity risk do I have to take today?
And that definitely feels like a decision a lot of people are making right now, Rick. Yeah. We are out of time for now. Rick Reeder, BlackRock Global Fixed Income Chief Investment Officer. Thanks a lot. Appreciate it. Carvana shares getting a lift this morning. That's a trending ticker after announcing it's offering note holders the option to exchange their unsecured notes at a premium to current trading prices. Exchanging note holders can receive new secured notes that would provide collateral while reducing Carvana's cash interest expense. The online used car retailer offering to exchange up to $1 billion of bond principal at below par prices as Carvana attempts a restructuring of its debt load. What does all of that mean? The market views Carvana as potentially having liquidity concerns. It's got a lot of debt, and so it is trying now to attempt to fix that. Coming up, the road ahead for the banking sector. We'll have a panel of experts to discuss the fallout of Silicon Valley Bank and what investors can expect in the aftermath. That's next. Almost 45 minutes into the trading session. Let's do a quick check of the market sponsored by Tasty Trade. We see a little bit of a downdraft for the major averages here, but of course, people are holding back on making bets until we hear from the Federal Reserve this afternoon in terms of their rate decision and the commentary surrounding it. The backdrop for the Fed decision, of course, is the banking turmoil as of late. Fed Chair Jay Powell's comments today set for intense scrutiny after the collapse of SVB and the fear it created over contagion to the wider financial system. That's not even bringing in Credit Suisse and UBS, et cetera, to the whole situation. Let's sort of take a step back and look at what's gotten us here. Joining us now is David Gura, NPR business desk correspondent. David, formerly an anchor at MSNBC and a correspondent for Bloomberg Television and Radio, which is where I got to know him, former colleague of mine. Dave, good to see you. So in your reporting, as this is all unfolded, sort of how are you thinking about it as we are now at a point where there's some relative calm?
I mean, it's been a wild ride just because so much of this has been sentiment driven, as you know, Julie. And I think that that's kind of like we're at this point now where you say this is the backdrop to what's happening at this meeting, and a backdrop I think that the Fed chair is going to feel duty bound to address and talk about. But we're at this point now where you've got policymakers and lawmakers with this dual impulse to look back and conduct this postmortem of what happened. I think that's certainly happening at the Federal Reserve and on Capitol Hill as well, certainly happening among other bankers. And then this effort to sort of move forward to look ahead to what might happen. And you had the Treasury Secretary yesterday coming out in that speech before the American Bankers Association talking about how the government stands ready, basically, to intervene if this were similar circumstances were to befall other smaller banks. So, this impulse to look forward and look back. And in the moment here, I think we are at a point where I don't know if cooler heads are prevailing, but folks are exhaling after what's been a pretty wild, bumpy ride here over the last, 10, 11 days.
David, what do you think the biggest lesson learned, perhaps, that banks are going to be able to take away from the turmoil that's ensued here?
I mean, I think that for a couple of things. First of all, I'm struck by how this has sort of highlighted once again this divide between what goes on in Washington, what goes on the West Coast. I think that can't be overplayed. The fact that there has been this uneasy relationship between tech and Silicon Valley and Washington policy, and certainly the postmortem that's taking place inside the Fed that Michael Barr is running is going to look at how the San Francisco Fed and other policymakers made missteps clearly and were unable to see the problems with this balance sheet. I've been struck just looking back on what the chair of the FDIC said over the last year, warning about the sort of bond risks that Silicon Valley Bank had to deal with. I think that somebody told me earlier this week that this is kind of a show me story for banks right now, that there's this impulse on the part of customers to know, they want to know that their banks are safe and the balance sheets are safe. And I think that as a result of this, banks have learned a lesson that they have to be more forthright about where they stand, and they have to be more nimble about being in communication with their customers to show sort of how their portfolios stand and what their balance sheets look like.
Well, and I also think it's uncovered, maybe there's a lot of banking customers who don't necessarily understand the business model of banks, right? That they don't keep all of your money sitting in a vault somewhere, that they're actually using it to make their own money out in the market or what have you in other investments. And I wonder if you've talked to folks who have pulled deposits or considered pulling deposits and what that sounded like.
I think that's absolutely true. I myself haven't talked to a lot of customers who are in that position, but I have colleagues who have. And I think there was that immediate sense of worry because I think a lot of people just aren't even familiar with the basics of sort of what the FDIC customarily insures or doesn't. And there was this fear in the aftermath, obviously, that even if you didn't have $250,000 or more in Silicon Valley Bank or Signature Bank or any of these other smaller regional banks, you were worried about there being any kind of backstop to that. So, yeah, I think that this is a moment when a lot of people are seeing the need to learn more about the way the banking system works and what's taken care of, what's insured and what's not. And, I think looking at the other side of that coin, I think that the government and regulators might see this as a lesson on their part to look more carefully at how that stuff is communicated, how people understand the way that banks work. Your point is a really good one, Julie, about sort of the fact that you think that you're locking up your money and, maybe it's being lent out to other customers of the bank, but by and large, it's pretty safe. And I think that, this added layer of how this kind of surge of cash for these banks was deployed into these low interest securities is something that I think a lot of people are just sort of coming around to and trying to figure out and understand. And, I don't know how long lasting that will be, but I think it certainly was a wake up call for a lot of customers.
And so now, even with the uninsured deposits that have been put forward from a range of banks, about 11 of them, I believe, to the tune of $30 billion towards First Republic in itself, and now thinking more broadly about what that could do in terms of turning into an injection of capital, an infusion of capital, I believe, as they put it. Now the larger question is, what does this mean in terms of the options for some of the regional banks, even to just navigate this interim crisis, as some have called it, even as one of our guests has said he hesitates to call it a crisis earlier this week?
Yeah, it's been interesting. Like, the semantics of this have been really wild. We've debated internally, just to be candid, whether we call it that, accepting the fact, acknowledging the fact that this is not like 2008 sort of, is crisis the right term here? I think another thing we're kind of watching unfold here is how slow these regulators tend to move and the government apparatus tends to move. So yeah, there is this fear among a number of these kind of mega regional banks, First Republic primarily, of what's going to happen here. As you say, there's this discussion about a second deal following on that $30 billion cash infusion, what that looks like. I think that there is, as there often is the case, companies want to see the government match the urgency that they're feeling at this time. We're seeing that now. I don't know how all of that pans out, but it was astonishing to me twofold. Like, after the collapse of Silicon Valley Bank and Signature Bank, you had First Republic essentially doing the right thing, lining up financing from JP Morgan and the Fed and acknowledging the fact that they could get more through this new facility. And yet investors didn't buy it when the markets opened on Monday. And you saw the same kind of thing play out after this deal was announced that was brokered by Jamie Dimon of JP Morgan, this $30 billion deal. There was this immediate celebration that followed that, statement from the Federal Reserve, the Treasury, and the FDIC welcoming what these banks had put together. And yet the market reaction certainly wasn't as strong as I think both the banks that came together and those regulators thought it would be. So again, I go back to what I said just at the beginning, which is like sentiment is it's a real devil in all of this. And it's a real lesson, again, as many people have learned before, but I think for a lot of people it's new, just how when there's a bank run, that contagion can spread, and a bank run is really hard to slow down as it moves from bank to bank to bank.
David, great to get your insight and perspective around all of what is continuing to play out even now. David Gura, NPR Business Desk correspondent. Thanks so much for joining us this morning.
Nice to see you.
Good to see you. And let's continue our conversation on the financial fallout that began with the collapse of Silicon Valley Bank and the subsequent stabilization efforts put in place by banks and governments, both here and abroad. Joining us now for a global look, Gillian Tett, editorial board chair and editor-at-large for the U.S. at the Financial Times, Dylan Ratigan, who is the host of Truth or Skepticism on Tasty Trade, and Peter Tout Larson, who is the global editor at Reuters Breaking Views. Thank you all for joining us this morning. Gillian, first, I want to begin with you. Earlier this week, we had State Street Global Advisors Michael Aroni, who said he saw no reason to panic here, and particularly around the crisis word. I want to play this clip and get your reaction on the other side.
I think that it's clear that government officials, central banks, and even the banking sector is doing everything they can to contain I even hesitate to call it a crisis, the challenges within the regional bank sector. And Julie, just a moment ago, you were pointing out, even today, if we look at those regional banks, a number of them are up so far this morning.
And so there's been a lot of semantics about whether or not we should be calling this a crisis, but the reality here is that there's a magnitude of impacts, and many still asking if there's an sensationalization of the turmoil warranted, considering those web of impacted parties. Would love to get your perspective.
Well, the good news is that we are seeing some recovery in bank shares and signs, according to the US Treasury, that the outflow of deposits has slowed down overall, although we can't get a breakdown in terms of individual banks, and it's still very unclear what's happening at First Republic. The other bit of good news is that some kind of deal has been cobbled together in Switzerland, albeit very, very controversially. The bad news, though, is that, as you just heard, the reaction in the markets to this extraordinary attempted rescue of First Republic has not been as nearly as positive as the government had hoped. First Republic still is clearly very, very challenged. And the other bit of bad news is that there's still a sense that the interest rate problems that caused the issues initially at Silicon Valley Bank are still bubbling at many, many other regional banks. And on top of that, there's a really big question, which is, given that this has primarily been an interest rate risk linked crisis, and that's what's caused the liquidity problems at the banks, are we now going to see this morph into a credit problem, whereby we begin to see, unfortunately, some of the losses, some of the loans that banks have made have problems.
And Peter, I want to bring you into this because as we sort of look at the international banking system, the Credit Suisse UBS situation seems to have stemmed the bleeding, so to speak, for now. You have that on top of some of the regional banks in the U.S. still perhaps being troubled. Sort of what's the global view on stability, on financial stability right now?
Well, I think there's a couple of things. I mean, part of it is just, the sort of the weakest wildebeest at the back of the pack are getting eaten, basically, right? I mean, Credit Suisse has had problems for a long time. Silicon Valley Bank was the one that had the greatest exposure in terms of unrealized losses on long-dated securities. So those things tend to go first. The question then is really whether, to what extent that spreads. I think there's a couple of ways in which that could happen. One is in the US, obviously, this question over uninsured deposits and whether they're at risk, which the authorities are doing their utmost to try and calm people down on. The other point of contagion potentially is what happened in Switzerland over the weekend, which was the Swiss government's decision to write down to zero these additional capital bonds that Credit Suisse had issued, basically by changing the law over the weekend. And now everybody asking the question across Europe and elsewhere, sort of, could that happen here as well? So I think those are the immediate factors. And then, but the underlying point in all of this is interest rates are rising, and we've had, a decade and a half of ultra low interest rates. And the Credit Suisse and SVB situations show you that people are not prepared for that to happen. And so the consequences of that will continue to filter through.
And so, Peter, as well, kind of thinking through where the contagion has actually led to already, as Dylan was mentioning a moment ago, some consolidation, or even after that consolidation, what can be expected by clients of these banks to the service level agreement that they should be able to uphold their financial institutions as well?
Well, I think it depends. I mean, the interesting, Credit Suisse and SVB are very different, but one thing they had in common is that they both catered to very wealthy clients, right? I mean, in Credit Suisse's case, millionaires and billionaires, and SVB obviously had all these venture capital firms and startups depositing their money with it. So they were probably particularly susceptible to a run in a sort of an online, people being very aware of what's going on type of world. I think the other question here, though, is that we've seen in both cases, despite everything that happened after 2008 and all the regulations that were passed and so forth, we're still seeing essentially the authorities coming to the rescue. Right. I mean, in the case of SVB, they stepped in and guaranteed the deposits. And in this case of Credit Suisse, basically UBS was ordered to buy Credit Suisse, and the Swiss government then changed all kinds of laws in order to allow that to happen quickly. So we're still slightly in the sort of the 2008 playbook, which is the government is ultimately there on the hook. And if that is the case, then I think that probably also changes the way people think about different governments and their ability to support their banking systems.
Yeah, on that front, Dylan, let's bring you into this. It's good to see you, by the way. It's been a while. As we mentioned, you're host of a podcast called Truth or Skepticism. So let's bring in some skepticism. You in the past have been critical of, particularly following the 2008 crisis, critical of sort of the system, the regulatory framework. Do you think that was really a failure that led to maybe not just SVB, but also in some ways Credit Suisse?
Oh yeah, I mean, it's not even a question. It's not an opinion. They chose to create two classes of banks in 2008. Those that are too big to fail. There are four of them, and then they created everybody else, and that was their solution. They said, "Well, we're going to ratify." Rahm Emanuel said in the meeting for Dodd-Frank, "If you vote for this bill, you will never have to have another TARP vote again as long as you live, because we can directly connect the Federal Reserve to the big banks and bail them out without anybody knowing." That was the law that was passed in 2008. And so you had two classes of bank. Now you fast forward, the second class of banks, pick them, we're using these names that are the ones now, well, they fail. Well, guess what? They're also insured 100%. I think that the charade that every bank is not completely supported is not helpful. because we're sort of pretending like, oh, capitalism, and oh, you have your money, you fail your money, you lose your money. And then not true, not true. The way it works is if you work at a bank, you can create more risk two ways. Credit risk, which is what they did in 08, you reduce your credit quality, or duration risk, which what Peter just referenced here, which is you go into longer dated investments and in their case, and in many cases, don't hedge. When you create more risk, whether it's through duration or credit risk, and you're a bank CEO, bank board member, bank executive, you pay yourself millions or tens of millions of dollars a year, each year, and it lasts for 3, 4, 5, 6, 7, 8, 9, 10 years. And at the end of that, because that is a terrible way to manage risk, when you fail, the government will bail you out. That's the global banking system. That's not I don't care what the rules say. If you run a bank, the logical incentive is to manufacture risk and compensate yourself as much as possible until it finally blows up. The bank will then be bailed out. The equity might be dissolved, but there will never be compensation clawbacks. And the consequence of this is you have bankers that are incentivized to manufacture risk that can be transferred to the government rather than provide a service, which is to facilitate the flow of credit and capital to actual enterprises. Enterprise business, whether it's the startups of Silicon Valley or whether it's industrial manufacturing. We started a glove manufacturer. We had a $50 million contract from the Pentagon. Can you imagine if we had to go to 50 different banks to try to manage all of our vendors because it's the depositor's responsibility to manage risk? It's laughable. And so I think that this is a good opportunity if people want to understand that the banking system is completely backstopped everywhere, that the implication that some are and some are not is useful for the more powerful. So we want people to perceive at First Republic to be vulnerable because other banks want to buy it for free. Every time that it gets a little squirrely, if you pretend to be capitalist for a few weeks, you're able to knock off the weak wildebeest, as Peter said, buy them out for cheap, and then the buyer gets bailed out, whether it's UBS that takes the Credit Suisse book or whatever's going to happen with all of this. But I think we do ourselves a disservice to pretend that that's not the world we live in.
And Jillian, I want to kind of pivot to you and perhaps even get your reaction to that with the added thought of some economists saying that the banking sector turmoil has done the Fed's job for it. Do you believe that to be true?
Well, it's done the Fed's job for it in the sense that it's tightened financial conditions really quite considerably. And there are analysts out there reckoning that the financial tightening is equivalent to around 25, 50 basis points hike as it is. But the issue for the Fed right now is that it's quite keen to separate out financial stability from the real economy insofar as it can. Of course, you never really can. But as Christine Lagarde of the European Central Bank said last week, there are different tasks for the Fed right now. So I suspect what the Fed will do is essentially continue to raise rates to signal its fight against inflation. So use a policy rate tool to basically try and go after inflation, but use its balance sheet to essentially try and stave off the financial instability risks. And we've seen that already. It's going to be very, very difficult. I'm very strongly in the camp of those who think the Fed made a terrible mistake to keep interest rates so low for so long. The reason we're having these shocks now is because it's had to overreact and jam on the brakes to essentially atone for the big mistake it made earlier. And I strongly agree with Peter that the fundamental problem, as I've written myself in numerous columns, is that most of the financial system has been geared to make a one-way bet on rates staying low forever, and they simply have not woken up yet to the risk. And the really big issue is that, yes, we started...
I would just argue they're aware of the risk, but I would argue, Jillian, they're aware of the risk, but they're expecting the bailout. In other words, there's ignorance, and then there's just like, so these are not stupid people. These are people that benefited from the credit expansion in 2006, 7, 8, 9. Then there was a massive overcompensation, which is the zero rates to compensate for their previous mess, which everybody agrees the Fed is out of control, running zero and getting all these more. And now, First Republic has mortgages out in California for 2.5%, and their borrowing rates are 5.5% at the short end. that's not a shock, right? At some point, rates were going to go up. I'm arguing that the risk is egregiously mismanaged, whether it was going into 2006, 7, 8, 9, with the credit, with the ninja loans, or whether it's the leverage on short rates now because they know they're going to get bailed out.
Well, and Julian, is that the risk then of the FDIC making the guarantee more explicit and saying there's no limit, let's just guarantee all deposits? Is that the risk then, that you are encouraging further risk-taking behavior?
Well, the only thing that's worse than moral hazard, which the system is riddled with right now, is that you have unpredictable moral hazard. And that's worse than moral hazard. Because yes, at the moment, we now know, in retrospect, that the depositors at Silicon Valley Bank and Signature were rescued. Yes, Janet Yellen said yesterday that that rescue, that support, will extend to other regional banks if they fall into problems too. But we don't actually know how far the FDIC support goes, whether it's going to cover all the banks. And perhaps most critically of all, although we've seen the banks break first in relation to the interest rate cycle going up, or interest rates going up, and we're seeing some protection for them, what's going to happen if, say, commercial real estate starts breaking big time, as we've heard earlier, it may well start to do? What are we going to do about private equity, venture capital? What are we going to do about university foundations? There are many, many parts of the financial system right now which could also be hurt very badly by interest rates going up. And we just don't know whether the government's going to step in and provide that kind of moral hazard or support or bailout there as well. So for investors, it's incredibly confusing because you could neither trust on free market mechanisms to set the price of things completely. We've seen with the Credit Suisse UBS deal that the government stepped in and meddled there extremely extensively. So you can't really trust free market mechanisms, but you just don't know yet whether the government is actually going to come out and bail out the entire system or just select.
Yeah, I mean, well, actually, Dylan, I want to let Peter get in.
I have to emphasize, this is worst case scenario. What Jillian described, which is stochastic moral hazard, is the worst potential economic policy you could imagine.
Right. Stochastic is a big word, but yes.
So, Peter, I wanted to bring you in here for the last word, because what Dylan and Jillian are talking about is indeed a worst case scenario, right? It's sort of a dire scenario. Do you think that's what's going to happen? Is that what we're headed into here? What do the next 3 to 6 months even look like?
I mean, look, it's very difficult to predict, but I think Jillian made the important point just now, which is that we're talking about the banking system, but I think we can all agree the banking system is I mean, it's not safe, but it's safer than it was in 2008. In 2008, the banking system was at the heart of the problems. And I think the banking system until now has been a bit more of a shock absorber. And okay, we'll see how that goes and whether there are other things lurking on the balance sheets that come to light that make this a more serious problem for a bigger number of banks. But what's happened since 2008, quite deliberately, the regulators designed it this way, is that they've pushed a lot of risk out of the banking system and into financial markets, into funds, into private equity, into various other things, and hedge funds and so forth. And that was very deliberate, because the idea was that those entities would not put consumers at risk in quite the same way. But it hasn't quite worked that way. And we've seen a couple of times now, most notably in 2020 during the COVID pandemic, that the central banks had to come in and backstop financial market instruments in order to prevent fallout and prevent damage to the economy. And so I think that's the other big lurking risk here is what other unexploded landmines are there out there that are beyond the reach of the financial regulators directly, but that they may have to come in and take care of if it turns into a real problem for the economy.
Yeah, I think that one thing we've learned throughout the past, 20 years plus of covering finances, they'll find new ways to take on risk that we haven't necessarily foreseen. Thanks, guys. Really great to get your collective perspective here.
Thank you.
Dylan Ratigan, host of Truth or Skepticism on Tasty Trade, Peter Thal-Larsen of Reuters Breaking Views, and Jillian Tett of the Financial Times. Thanks again, guys. Coming up, Moderna is defending its COVID-19 vaccine price hikes before the Senate. Our Anjali Kamlani has the latest next.
CEO of Moderna is testifying before the Senate's Health, Education, Labor, and Pensions Committee to help defend the healthcare company's decision to charge $130 per dose of its COVID-19 vaccine once it hits commercial markets in May. Yahoo Finance's Anjali Kamlani has the latest on this. Anjali.
That's right, Brad and Julie, really listening in on that hearing just now. It has just started off. We've just gotten a little bit past opening statements, and the Moderna CEO are really having to defend not only the NIH contribution to the development of the vaccine, but also the decision then to increase the price as the company is going to be facing the commercial market now that it is off of the pandemic market and really leaning on the government for distribution of the vaccine and the initial development. One interesting piece of information we got is that the company is looking at what would be a 90% reduction in demand based on what the pandemic market was, especially as we know the first round of doses. And then that first round of boosters really was the driving force behind vaccine demand early on, not just for Moderna, but also for Pfizer as well as Johnson & Johnson. As you see on your screen, the numbers of what has taken place over time, the known cost of production of those 10-dose vials, as well as the government contribution there. But what the company is saying right now is that in addition to this lowering demand, they're also facing an increase in costs, and that includes pre-filled syringes or single-dose vials, and that is going to increase the cost of what they have to produce, as well as distribute and ship out as well. So that's sort of where Moderna's case is. Senator Bernie Sanders really coming down hard on the company for, increasing prices on a product that taxpayers have contributed to. He did say in a letter previously that the recent taxpayer money was really to protect the American people, not to line the pockets of corporate executives. And he has tried to start that discussion about how, all of this funding really did produce multi-billionaires in the form of Moderna CEO and the executives there. So that's where things are right now. We're expecting this to become a pretty heated discussion as the day unfolds.
Yes, looking forward to seeing some clips of that and seeing what kind of questioning he gets. Thanks, Anjali, for bringing us that. Appreciate it. Coming up, a rough day for Petco after some not so positive earnings. We're going to speak with the company's CEO about what is next.
TikTok CEO Shou Zichu set to testify in front of Congress for the very first time on Thursday.
Hi everyone, it's Shou here. I'm the CEO of TikTok. I'm here in Washington, D.C. today.
So here's 3 things that I'll be looking for. Number 1, national security. How will TikTok address privacy and data security concerns, as well as how it handles user data, and what would TikTok do if the Chinese government says hand that data over? Also, the money that comes with a ban. Ahead of Shou Zichu's testimony, TikTok this week revealed its monthly active users in the US hit 150 million. That's a jump of 50% in the past 2+ years.
That's almost half of the US coming to TikTok. Now this comes at a pivotal moment for us. Some politicians have started talking about banning TikTok.
A ban could potentially hurt the more than 100,000 creators using it for extra income. It could backfire if lawmakers see that big growth as a sign TikTok is becoming too big with too little transparency on its ownership structure. Number 3, influence or interference. Now, 2024, you have a presidential election year, so expect questions on misinformation, political influence, and even how children are affected by the content. Now, even with a TikTok ban on government devices coming up in the US, President Biden did appear in a TikTok with Niall Horan for St. Patrick's Day.
Happy St. Patrick's Day.
Happy St. Patrick's Day. But anyway, you have this backdrop of strained relations between the US and China on tech, and that will loom the largest over all the proceedings.
Shares of Petco are sinking today after the company's fourth quarter earnings raised some concerns for investors. Petco CEO Ron Copeland joins us now alongside Yahoo Finance's Brian Sozzi. Ron, thank you so much for being here. Obviously, we've got the shares trading down today. I mean, what's the message you want to sort of put out to investors in the face of these numbers?
Hi, Julie. Great to see you, and Brian and Brad. So if you look at our earnings, we beat on the top line from a revenue standpoint. We beat our EBITDA line. And we had terrific cash performance, so good that we paid down an incremental $35 million of debt last week, and we committed to an incremental $100 million as we go into 2023. If you look at it from a customer standpoint, we added over 1 million customers in 2022, which was great, and we hit a milestone of 500,000 on Vital Care. So overall, I just want to say thanks to the team for delivering a solid quarter.
Ron, I came across a Evercore report that did a preview of your earnings before they hit, and they said at the top, pet parents are making tough choices on what to buy when they go into the store because of the current macroeconomic environment. What tough choices do you see them making when they come in?
Yeah, so let me actually challenge the assertion and then reinforce it. So first, within our portfolio, we continue to premiumize to more premium products. So our fresh frozen products are growing double digits. Our Taste of the Wild or Origin in a Can of products that are $100 bags, we continue to grow double digits. So actually within our portfolio, we continue to premiumize. There are lower spending customers that are looking for more value. And for those types of customers, we have some great loyalty programs like Vital Care, which saves them $400 in a year. So you have a bifurcation in the consumer, if you will.
Okay, and so even within that bifurcation in the consumer is clearly, yes, I mean, you got to feed your pet at the end of the day, but do they buy into some of the other products? Have you been seeing continued weakness in that, and or on the other side where you've invested in the services and veterinary services specifically, where have you seen more of kind of buying into this plan that you've been able to roll out, specifically targeting some of the PALS members, knowing that they are more frequent purchaser for the company?
Yeah, great question, Brad. Thank you. So if you look at our consumables, they're growing double digit. You look at our services growing double digit. We now have almost 250 veterinary hospitals from only 10 in 2018. So we are more and more becoming a services business, to your question. In terms of Vital Care, we got to 500,000 customers. Those customers are spending 3.6 times more than an average customer. And importantly, they're margin accretive from a dollar standpoint to our business. So those are positive trends. I do want to go back to, you look at in these types of economies, you want to look for categories that are growth categories. The pet category has been a growth category. Time immemorial is a growth category in the last 2 recessions, and it's growing through these economic times as well. And we had a comp of 5%. Within this type of economic environment, a comp of 5% is a good number.
Ron, we are, I think a lot of folks can agree, in some form of banking crisis. It's been a challenging 2 weeks for the financial services industry. Is this the moment where you're huddled up your CFO, thinking about your balance sheet, how much debt you have on your balance sheet, how many stores you have open, and how are you thinking about just protecting your business moving forward?
Yeah, so let me break that into 2 pieces. First, from a banking standpoint, the vast majority of our deposits are with the large national players, top-tier players, and we have no exposure to any of the banks that have been discussed over the last few days. Secondly, that's why we're so thrilled that our cash flow was strong, because we paid down an incremental 35 last week, and we committed to 100 because we are seeing such positive cash flow trends. We also put a collar on our debt to cap the impact from any future interest rate hikes. So we've really insulated ourselves from that. We're focused on operating the business, and delivering a 5% comp, I think, is good operating the business.
I guess I would ask if you're making any changes operationally, right? Are you changing the mix of products that you're putting out there to adjust as people are buying fewer discretionary items, for example? Are you cutting back on staff at all? Are you cutting back on CapEx plans at all? Any kind of changes you're making with the view of some of this changing spending patterns that you're seeing?
Yeah, we got smarter about some of the capital expenditures. Last year, we put 1,000 coolers in, so we already did that. We had some IT debt, so we were able to take some of those capital dollars and reinvest them against our debt as well as against our veterinary network investments. We are supplementing our what I call the OPP, opening price point, for more value-conscious customers. And then we're really driving customers towards Vital Care, where they can save $400 a year through free exams, grooming, and training discounts. But in turn, we get a greater share of wallet. So 30% of those Vital Care customers are new to food with us, 40% are new to services with us, which is a good thing for our business. So the customer wins and we win.
Ron, always great to get an update and get some time with you. Petco CEO Ron Coughlin alongside Yahoo Finance's Brian Sosny. Thanks so much.
Thank you.
Switching gears, everyone. 2022, it was a tough year for retirement savers. The average balances for 401k and IRA accounts, they sank by more than 20%, according to Fidelity Investment Analysis. And 2023's turmoil has not helped. Here to talk retirement tax strategy is Tim Spiess, who is the partner in charge, much different title there, Tim, partner in charge over at Eisner Ramper's Personal Wealth Advisors Group. He joins us as part of our Taxes Made Simple segment brought to you by Fidelity Investments. Okay, so first thing that people need to know as we are squarely in the throes of this tax season and people are getting ready, how can they best position, especially their retirement accounts, as they're planning for that next leg of life, perhaps?
Right. So what they should be doing is visiting with their investment advisor or the plan administrator. They often offer resources, looking at their spending, looking at their goals, looking to a retirement age. We're in a world now where retirement age, it varies. Mm-hmm. People wanting to perhaps take an early out or wanting to work longer. And all of that deserves a lot of thought, asset allocation, spending, a lot of related factors, risk tolerance is everything that should be considered. Also, what do you have now is invested? What are your cash flow needs? We do a lot of that in the context of modeling and helping clients understand. Visually, when they see that, it's very it's very much more real, because it's very difficult to think through these things in your head without any modeling.
And it's not just asset allocation, it's a vehicle allocation, if you will. When you're thinking about your taxes, for example, in retirement, are you looking at a Roth? Are you looking at a 401k?
Correct.
What are the different considerations tax-wise?
Well, the accumulation within a Roth is not as powerful. And I would say the tax benefit's not as similarly robust as the 401k plans. I mean, the 401k plans can allow you to defer more monies. And I think that's a significant issue versus perhaps being in a plan that doesn't allow you to do that. The key, though, is participation. Enrolling, understanding your risk tolerance, how you should be investing, taking proper measured risk in the context of maybe some higher yield fixed income. By the way, all of these things would have to be vetted and make sure that it's an appropriate investment for the individual. But most plans that we see have a lot of investment options. But to me, it still comes down to the counseling of the individual. And many firms offer that. Right. They offer the counseling, as does employers. So I would say those are the top three things.
Thankfully, because it's very complicated.
Right. It is. Well, it is. And sometimes people are just, I can't say it any more gently, it's intimidating. Yeah. Mm-hmm. And they understand that they're investing for 10, 20 longer periods of time. They have families. They're concerned about a healthcare issue that might arise.
Sure.
This is why retirement planning, the way we see it, is done in the context of a total financial plan.
Right. And within that total financial plan, even between last year and this year, how has the number for some of the clients that you work with, how has the number that they keep as kind of the pie in the sky figure, how has that changed between last year and this year, even knowing how their expenses have changed in that interim period of time as well?
Do you mean in the context of, say, a present or perspective like target balance?
Sure.
Okay, yes. I think people have, there's two types here, and I won't say they're extreme, but there are two types. Those that still feel cautious, want to save as much as they can, willing to take some risk, but perhaps not as much as they might have if their state of mind was 4 years back. Mm-hmm. And then there's others that are very sober about where we are. They have a good handle on their finances, their spending, their asset allocation models, yield and growth. So I would say those are the two general types of investors. Others are running funds, and that's a totally different. I would call that a totally different category. But I think what we try to do is understand, very important, the objectives and the risk tolerance. That's really important, because you don't want to have your relationships uncomfortable with your advice unless you can help them understand why, and then that they have another choice. And so that's actually the way we approach our total business, actually, across the firm. So it's always made sense to me
Well, Tim,
to approach it that way.
Thank you so much for being here, because
Thank you.
obviously this is important stuff for people to be considering at tax season, but really all the time when we're
All
talking
year
about
round. Yeah.
retirement. It's really, really important, and people don't know enough about it and don't do enough about it. So Tim Spies, thank you for being here. Eisner Amper.
Thank you for having me very much.
Appreciate it.
Bye.
Well, coming up, Rochelle Okubo is going to continue our coverage ahead of the Fed decision at 2 p.m. Eastern with an economist from Aberdeen. Ahead of that, markets have turned into the green, Brad, but still not seeing much change, because really we know everything hinges on the Fed decision this afternoon, the tone they strike, what the dots look like, if they even have dots today. There are a lot of questions that we need answered.
Yeah, I know. Break out those Dippin' dots to really backfill for the dots that you might not get from the Fed. But ultimately, taking a look at some of these sectors, the activity that we're seeing right now, real estate really still pulling up the rear, down right now by about 1.4%. However, you got technology and consumer staples. They are leading the pack here on the day from a sector performance.
Really fascinating. Rick Reeder today really targeting what are the risks in commercial real estate in particular as a result of rising rates. Something our panel talked about as well. It is something we will continue to be watching. But for now, we leave it there. I'm going to be back for the Fed this afternoon, actually, so you can watch me there. And Rochelle Okubo has you for the next hour.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching. The balancing act. Fed decisions are rarely as uncertain as today's, with concern swirling over the stability of the financial system. Will we get a hike, a pause, a cut even? Economic projections are expected, but some strategists think they'll hold them until things get clearer. And cryptic times, Bitcoin benefiting from the uncertainty and pushing higher ahead of the decision. Now, is this a meaningful move towards 30,000, or is Jay Powell set to rain on this parade? An expert will tell us the 5 deadly risks to avoid. And is AI crucial for the future of education? We speak with entrepreneur Sal Khan on his digital learning group and the role ChatGPT could play as a teaching tool for the leaders of tomorrow. But first, let's check in on the major indices. Started in the red, in the green for now though, but we've seen some of this buying action really slowing down as we head into this hour and a half of trading. We're also seeing that tech was leading the pack in terms of sectors. You're also seeing commercial real estate really being dragged down sector-wise. But for now, as we just saw, the Dow now turning mixed. The Dow, they're just down slightly, about 4 points on the day. The S&P down just about 1/10%. Similar situation for the Nasdaq as well, ahead of that Fed announcement. All right, let's also check in on the Treasury market. Always impacted by what we're seeing with the Fed. We're seeing the short-term yields flat. Also, some uncertainty we're seeing here in the 10-year as well, down just slightly, about 0.2%. And the 30-year there, down 0.6% on the day, obviously awaiting that rate hike decision. Right, turning now to our top story. The Fed's decision today closely watched after more than a week of instability in both banks, regional and abroad. Now, all this after Silicon Valley Bank's collapse created a contagion effect with repercussions felt around the world. Here with more, Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Good morning, Rochelle. Fed officials meeting right now in arguably one of the most uncertain policy meetings in years. Typically going into a policy meeting, Fed officials clearly telegraph their intentions for the policy meeting. But we were in a quiet period when Silicon Valley Bank failed, touching off contagion in the banking sector, ultimately leaving a lot of question marks around what the Fed will do today. Before Silicon Valley Bank's failure just 2 weeks ago, Fed Chair Powell had opened the door to what markets interpreted as a 50 basis point rate hike. And given strong CPI and jobs reports from February, that might have been on the table absent a banking crisis. Today, markets now largely expect the Fed to raise its benchmark interest rate by 1/4 percentage point to a new range of 4.75% and 5%. But there are a range of views. In the 25 basis point rate hike camp, we've got Piper Sandler, JP Morgan, Morgan Stanley, and Wilmington Trust, all noting that high inflation keeps pressure on the Fed to hike. In the no hike camp, Goldman Sachs expects the Fed to pause, citing stress in the banking system, this down from their previous call for a 25 basis point rate hike. Now, one outlier, Nomura Securities, which is calling for a 25 basis point rate cut and a halt in the Fed's quantitative tightening program in March due to the financial stability risks in the banking system. Now, questions are also swirling about what sort of combination the Fed could pull here. Is it raise by 25 basis points and stop QT, or is it raise by 25 but lower their interest rate expectations significantly? Today, investors will receive officials' new projections for how high the central bank expects to ultimately raise rates. 3 weeks ago, Fed Chair Powell had signaled rates would need to be raised higher than the range of 5 to 5.25 penciled in back in December. We will understand just how those bank failures are influencing the Fed's monetary policy when that decision comes down at 2 p.m. Eastern, followed by Fed Chair's press conference at 2:30 p.m. The suspense is killing us. I know. Rochelle, back to you.
Indeed. It certainly seems to be killing some of the mood in the markets at the moment, the closer we get. Jennifer Schonberger there, thank you so much. Well, constructive action by regulators to support the U.S. banking system after Silicon Valley Bank's collapse hasn't been enough to calm markets or ease insolvency fears among investors or bank depositors. Still, officials are focusing on restoring confidence. Treasury Secretary Janet Yellen spoke on the subject yesterday in her keynote address at the American Banking Association's Washington Summit. Take a listen.
Our banking system is sound, even as it's come under some pressure. As I indicated, This is different than 2008. 2008 was a solvency crisis. Rather, what we're seeing are contagious bank runs. We demonstrated last week that the federal government is resolutely committed to taking actions that will mitigate financial stability risks where that's necessary. And every step we have taken has been intended to reassure the public that our banking system is resilient and that we stand behind the banking system.
Well, joining us now to discuss the path ahead as the Fed looks to balance the bank stability crisis as well as inflation is ABRDN research economist Abigail Watt. Abigail, thank you for joining me this morning. So as we look at this balancing act, what are you expecting to hear from Jay Powell in terms of the narrative? We know investors will all be listening very closely.
Yeah, look, I think this obviously, as you've said, is a really pivotal meeting for the Fed. Our expectations are that the Fed will deliver a 25 basis point hike, but clearly, I mean, the decision is likely on a knife edge for the Fed today. And I think in terms of their communication and how they kind of handle the press conference, I think if they choose to deliver that 25 basis point hike, then I think they're likely to kind of focus a lot more on the financial stability concerns, pushing towards kind of saying around the different tools that they have to deal with those financial stability concerns, and I guess separating the kind of fight on inflation from the kind of ongoing turmoil in the banking sector. But if they choose to not hike, then I think the press conference tone could be very different. I think they'll likely be much more hawkish in their stance in the press conference, and I think that's likely because they still have that inflation fight to go somewhat, and I think they would be conscious that pause should be predicated on the view that they will then return to hiking again once markets have calmed a little.
And it's tough because, the Fed was accused of being behind the ball when it came to recognizing how sticky inflation was going to be. So now at this point, then, depending on what they do, as we've seen across the camp, a lot of different views on what the Fed could and should do at this meeting. How much of the Fed's credibility is on the line?
I think it's a really good question, and I think this is perhaps slightly why we're erring towards the 25 basis point hike, because I think the fundamentals in the economy, we saw kind of stickier inflation, we've seen the labor market tightness persisting, and we've seen activity actually holding up fairly well into the turn of the year. And so I think in terms of the Fed's credibility, they'll be really conscious of that inflation fight and the fact that is ongoing. And I think if you think about the turmoil in the banking sector, I think as well, not hiking, does that suggest to investors that the Fed are more concerned than they perhaps currently think they are? And I think that it will be in a really important balancing act for the Fed today.
And of course, everyone keeping an eye on recession risk. Data from Bank of America researchers seeing an uptick in recession risk. 42% of fund managers surveyed predict a recession within the next 12 months. And it was just at 24% in February. How have your recession expectations changed?
So we've been expecting the US to enter a recession since June last year. We originally projected that they would enter that recession by Q2 this year. We saw the strength of the data at the beginning of the year and we pushed that back. But I think there's a question as to whether some of the turmoil you've seen in the banking sector actually pulls forward the timing of that recession. So whether we see the US enter a recession over the summer instead. I think in terms of how that's how this is shifting our expectations of a recession, I think the way that we think about it is actually that some of the tightening that we're likely to see in credit conditions off the back of the banking sector turmoil might do some of the Fed's work for it. We might see kind of that tightening in financial conditions feed into the real economy a little faster, and then the Fed likely doesn't have to hike rates as much as we had originally expected them to.
So then beyond this meeting then, we know that Jennifer was talking about that formula of trying to manage inflation while also trying to decide what to do with quantitative tightening or easing there. What is your outlook on that?
So given we're expecting the US to enter a recession, and that recession that we're predicting is a run-of-the-mill recession, we're expecting a peak-to-trough decline in activity of around 2%. We expect that will have labor market impacts, and we think that ultimately some of the loosening in the labor market that will happen through that recession will lead to inflation eventually undershooting the Fed's target. And in that environment, we think it's highly likely that the Fed will cut rates back down to the zero lower bound. This is somewhere where we've had a little bit of pushback in terms of the extent to which we think the Fed will loosen policy. But I think it's likely that given the recession that we're forecasting, if that is realized, then we think the Fed will have to kind of loosen policy again through 2024.
And as we look at how some of these central banks are really addressing this, I mean, we saw the ECB determined to stay the course, even in the midst of Credit Suisse's collapse, still going for that 50 basis point hike. What are we seeing in terms of central bank coordination on this, or are we in a sort of uncharted territory?
Yeah, I think it's a really interesting question, because I think it also has implications for the Bank of England tomorrow. And I think the ECB kind of paved the way for the path for the Fed in terms of being able to kind of separate the financial stability and the inflation concerns at today's meeting. And I think if the Fed were to not hike 25 basis points today, then I think that kind of has knock-on implications for the Bank of England's meeting tomorrow. Obviously we saw the upside surprise in the inflation data out of the Bank of England today, out of the UK today. And I think that all things said, I think the Bank of England should be hiking 25 basis points tomorrow. But I do think you're right that there is perhaps a kind of knock-on effect if the Fed do not hike today.
We'll certainly be keeping an eye on that. ABRDN research economist Abigail Watt, thank you for joining me this morning.
Thank you.
You're very welcome. All right, Krispy Kreme getting a sweet upgrade. Truist raises their rating on the stock to buy from hold. As analyst Chappelle notes, Krispy Kreme should be one of the few packaged good companies that will post meaningful volume growth in 2023. Now, Truist also pointing to the brand's refreshed strategy and expansion opportunities, positioning the company well over the coming years. All right, coming up, are there opportunities for investing despite the current banking crisis? Stay tuned as we discuss next. Now a look at how the banking crisis is affecting small businesses. Regional mid-sized banks are the go-to fuel for small to medium enterprises, providing about half of all business lending. But if you're a small business, is a move to long-term debt the right one to hedge against exposure to the financial sector? We're here with more Laureen Gilbert, Wealthwise Financial CEO. Good to see you, Laureen. So obviously we do have a lot of different camps sort of trying to figure out what the Fed is going to do next, how long this banking crisis is going to play out. Where do you see the opportunities in this environment?
Well, there are a lot of opportunities. And what I think a lot of investors are going to miss is we now have Treasury Secretary indicating, in effect, that there's a backstop. And there's this new banking program that is going to offer $2 trillion to swap out securities out of banks and give them cash. And with that, that's effectively another way of saying QE, quantitative easing, versus QT, quantitative tightening. And with that, QE offers a tailwind in the markets. So with that, I think that we are going to see a tailwind. I also think as far as looking at fixed income, longer duration assets, both on the income side as well as the equity side, are going to benefit. So what does that mean? That means going out longer in duration on fixed income and looking at some technology names that benefit from long duration assets.
And Laureen, as you mentioned, Treasury Secretary Yellen there, obviously really focusing on these banks that have this systemic risk in terms of the ones that would qualify potentially for another backstop, SVB style. But then you also have SoFi offering access to up to $2 million in FDIC insurance for checking and savings. So when you have some of these banks sort of doing their own thing, and you also have this idea that some banks, the ones that have more systemic significance, are also in the picture to get more protection, what does that do then in terms of the investment landscape?
Well, I mean, it's good that we have banks that are offering the kind of security that people are looking for, because what is going on right now is there's a lot of money movement from the smaller regional banks to the large national banks. And with that, that's going to cause more stress to the regional bank system. So with that, a lot of the regional banks are talking to their clients, letting them know what additional security they may be offering. But from an individual or a business owner, they do need to be looking at their bank. They need to be looking at the strength of their bank and seeing what guarantees do they have. And if they're holding excess reserves more than $250,000, they need to know if there's any additional assurances. Because there hasn't been, that's where we're seeing a lot of movement. So from an investment landscape, I think there's still quite a bit of fallout for regional banks. And I think that there needs to be caution around trying to invest in that arena until some of this is sorted through. Of course, looking at the details, looking at the balance sheet, looking at the 10Ks, if you're interested, you can look at those publicly traded banks to see the strength of those banks. And with that, because there's been such a fallout, there are some regional banks that are quite strong that are being impacted on their stock price. So there could be that opportunity, but I would say you need to be cautious in the area of regional banks.
And I mean, even when people have been looking for safe havens, usually it's bonds, but when you think of the inflation risk attached to that, makes it less of a safe haven here. Where do you see the safe havens when you do have this sort of backdrop?
Well, the backdrop that we're looking at is most likely going into a recession. And so thinking about defensive areas of the market, like consumer staples, and being careful with valuations in that area, and then looking at healthcare as another defensive position. And then selectively, like I said, areas of technology, I think could be a valuable play as well. But definitely looking at a defensive measure when it comes to equity exposure.
And Laureen, what are you steering clear of at the moment as well?
Well, I think we're steering clear of utilities and areas that are more cyclical. Those would be areas that we are avoiding right now. Another area I will say that could have opportunity are real estate investments that have already been impacted by a fast interest rate increase environment and those rate hikes. And now offering long-term leases, and some of those companies could be attractive as well.
Of course, all eyes going to be on that Fed announcement that's coming out today. I mean, a lot of people, just the difference a week makes, we're all in on a 50 basis point hike. Now we're at the 25 basis point hike point. But would anything other than a quarter point hike, say a pause or a cut, what would that do to markets?
Yeah, I think that could be harmful in the sense that it would let the markets know that they're not really as serious about taming inflation. And so, and that could be problematic longer term. So I think it is 25 basis points, and you're absolutely right. We keep moving, the ball keeps moving. We thought it was going to be 50. Now we're back down to thinking it's going to be 25 after the banking crisis that we've experienced in the last few weeks. So with that, I think the Fed needs to stand firm, saying, look, we're still fighting inflation and balancing it with we're not going to try and destroy the economy and destroy the banking system. And so that is that fine line that they have to play, but 25 basis points could do that.
All right, we'll certainly be keeping an eye on it. Laureen Gilbert there, thank you so much. Wealthwise Financial CEO, thank you for your time this morning. All right, let's check in on the markets here, sponsored by Tasty Trade. We see that mixed picture now with the S&P also turning red, although fluctuating, they're relatively flat. The Dow there, though, accelerating some losses. They're down about 40 points, 0.1%. S&P, as we mentioned, they're relatively flat, though, oscillating quite a bit. And the Nasdaq there, also some of that selling action, that buying action slowing down as well, but still at least in the green for now, up about 0.1% or 12 points. All right, coming up, the price of Bitcoin moving ahead of the Fed's big decision today. But should you approach the space with caution? We break it down next. Crypto prices in focus ahead of the Fed meeting today. As you can see, all of them moving to the upside there, the major cryptocurrencies. So for more on the landscape, we welcome in Kiana Danielle, CEO of InvestDiva and author of Cryptocurrency Investing for Dummies. You did the first edition, but you also have the second edition coming out in March as well. Thank you for joining me this morning. So Kiana, a lot of people, they're seeing this rise of Bitcoin. They're saying, is this the time to jump in? What should people be doing with their Bitcoin at the moment?
Well, thank you for having me. And it's interesting because I literally asked on my social media, what do you think about crypto? And the very interesting thing is my first edition of my book came in crypto winter and nobody was interested. And then the crypto boom happened. And then now we're in winter again and the second edition came out. What should they be doing with the crypto they already have is a very different question than should they get in or not. If they already have crypto, depending on what kind of crypto they have, I would always recommend never to sell for a loss. Like that is literally Warren Buffett's first law of investing. I know he's not into crypto, but I actually do apply his investing strategy into cryptocurrency markets. And I typically try not to, I never sell at a loss. So if you have invested in a crypto asset that you were confident in, there was a reason why you got in. Hopefully there was a good reason why you got in. It wasn't like a hype or FOMO kind of thing, but it was like a real reason. You really believed in that asset. You really believed in the ideology and you want to be a part of the future, then you probably want to hold on to it. Now, if you're not in the cryptocurrency market, as the previous speaker was also saying, I also agree that there is a very, very high chance that we are going to be heading into a recession. So we are approaching our portfolios also with a more precaution and allocating and diversifying among other assets as well. And I could go deeper in that if you would like to.
Well, I want to first talk about some of the coins that you do like, because obviously, you know, Bitcoin is its own sort of monster. But then when you look at things like Ethereum and the use cases there, what are the coins that you like at the moment?
So I first heard about Bitcoin about in 2011. I was like, this is way too risky for me. I'm not going to get into it until 2016 that I dove like really into it. And I fell in love with it. And the reason for that was because of my background. And now this may or may not really resonate with anybody else, but I was born and raised in Iran to a Jewish family after the 1979 revolution when the new government of Iran took over. And my dad before that, he was a very successful CEO of a successful company, had a lot of money in Iran, in the bank account, and in their house, in his office. And after the revolution, the new government came in, seized all of his assets, seized his bank accounts, everything that he had. And I remember even after I was born, like years later, we still were keeping like my mom's jewelry and Persian carpets and like piano, things like that in our friend's house, because at any moment the government would come and raid our house to take anything that we would have. So this went on for 10 years. And 2016, when I was reading about Bitcoin and how decentralized it is, and the government cannot just come and take it from you, because you can, if you have put it in a safe place, that is, a crypto wallet. Right. There was like my dad, even if he had like half, like a portion of his assets in something like Bitcoin, if it existed at that time, we wouldn't have had so much problems with money. So in America, it's a little bit harder to understand this concept. But for me, Bitcoin really became something of a safety net, just in case everything goes down.
And to that point, obviously, with a lot of the volatility that we saw from the banks and the fallout from SVB, we did see that flood into it. We did sort of have that resurrected, that narrative of Bitcoin and crypto being a safe haven. But I do want to ask you, though, in terms of what people should be identifying, if they already have crypto or if they're thinking about getting into it, you've identified some of the deadly mistakes that you tend to see people make in this space. Lay those out for us.
Oh, yeah, absolutely. So here's the thing with any kind of investing, whether it's stocks, it's cryptocurrencies, it's bonds, it's private equity, it's real estate. The number one deadly mistake is falling for hype and FOMO. Like that is literally the number one. If you don't understand what the asset is, like if you don't understand what crypto is, until you really understand it, don't get into it. Just because Elon Musk said so, or like, you know, we had GameStop, we had this, we had that. falling for hype on FOMO is the #1 deadliest mistake. Why? Because even if you like fall for the right hype or right FOMO, and it's like the right good asset to be in, but because you didn't have the fundamental understanding about that asset, and if you're in it for the long game, which is the kind of investor that I am, I'm a long-term value investor. Once things go down, if you only got into that asset because somebody that you know your like cousin said so, you are going to get emotional, and emotions are what are going to wreck your portfolio. So to avoid that emotion, you need to handle your emotion before anything happens. You need to get in with the right understanding of what that asset is, what it means to you, how much confidence you have in that asset. So that is a #1 deadly mistake people make. And the reason why all of these things happen, because, you know, with the SVB, people are like, oh my gosh, high yields, let's go into it. Everybody is doing it. No, I didn't go to SVB because I'm like, cool, but it really doesn't align with my values. So I didn't do that, right? The second one is not protecting your asset. Again, I've been like yelling this out of the roof. You need to have your crypto, like the reason why you have crypto in your portfolio would be for security reasons and for diversification and for protection against the middleman. You need to have your assets in a wallet, in a crypto wallet. A crypto wallet is something like a USB that you transfer your assets, and then now you are the owner. The bank can't touch it, the government can't touch it, and whatever happens to the outside world, to all of the scams or whatever that is happening, your crypto would be safe. So get a crypto wallet. Don't keep it, no matter how much of a high yield they give you.
And Kiana, we only have time for one more, so we're getting your top 3 here, just very quickly as we're running out of time. What is your third?
I would just give you the third most important one. Absolutely, not knowing your risk tolerance. Understand your risk tolerance. Your risk tolerance is not just your emotions; it's your ability and willingness to take a risk. So at Investiva, that is literally what I teach. You need to know why you're getting in to something and measure your risk tolerance, your current financial situation, what your goal is, and then decide whether or not you should add cryptocurrency to your portfolio.
Certainly makes a difference if you're the long-term holding sort of investor. Otherwise, you're panicking every time you see a move in crypto. Kiana, Danielle, thank you so much for your time here on Yahoo Finance.
Thank you.
All right, Amazon, you're very welcome. Amazon is doubling down on its Fire TV business as the company announced it's expanding its line of televisions. Yahoo Finance's Ali Garfinkel is following the story and joins us now for more. Hey, Ali.
Hi, Rochelle. So the number of Amazon Fire TVs sold globally has officially surpassed 200 million. Now, what does that mean? Today, apparently, it means Amazon is really strengthening its commitment, doubling down on that Fire TV business. Now, what does that amount to? So there were 3 announcements that were pretty key. The first is that, one, it's launching new sizes of its high-end Fire TV Omni QLED series. And then it's also making a lot of these Fire TVs available in the UK, Germany, Mexico, international expansion. However, the thing I got really interested in was that it's introducing a more affordable option, the Fire TV 2 series. So you get a sense of the gulf between prices. The Fire TV 2 series starts at $199.99, while the QLED series starts at almost $450. So this is a surprise for a couple of different reasons. The first is that Amazon announced layoffs earlier this week, and the messaging from Amazon has been about cost-cutting, efficiency, finding everywhere they can to really find some cuts and efficiencies in the business. However, this does actually illuminate something that's, I think, a lot broader about Amazon right now, and it's that there are still areas they are investing in. An analyst from CFRA on the show was actually on just yesterday talking about this, how there are still areas that Amazon is ready to throw some money at. For example, Amazon Prime streaming content is going to be one of those areas. For example, Thursday Night Football, they spent $1 billion on that deal alone. And I think that the Fire TV links up with that, and it's clearly a place where Amazon is ready to bet on itself. And I guess the bottom line here is that it's not that they're not investing right now, it's that they're just not investing in everything.
So we're definitely being more strategic here. There's a lot of people trying to be more efficient, especially this year. Great stuff there. Ali Garfinkel there for us. Thanks so much. All right, coming up, startups are reeling from the loss of SVB. We dive into the VC space with an expert after the break. Stick around.
TikTok CEO Shou Zi set to testify in front of Congress for the very first time on Thursday.
Hi everyone, it's Shou here. I'm the CEO of TikTok. I'm here in Washington, D.C. today.
So here's 3 things that I'll be looking for. Number 1, national security. How will TikTok address privacy and data security concerns, as well as how it handles user data, and what would TikTok do if the Chinese government says hand that data over? Also, the money that comes with a ban. Ahead of Shou Zichu's testimony, TikTok this week revealed its monthly active users in the US hit 150 million. That's a jump of 50% in the past 2+ years.
That's almost half of the US coming to TikTok. Now this comes at a pivotal moment for us. Some politicians have started talking about banning TikTok.
A ban could potentially hurt the more than 100,000 creators using it for extra income. It could backfire if lawmakers see that big growth as a sign TikTok is becoming too big with too little transparency on its ownership structure. Number 3, influence or interference. Now, 2024, you have a presidential election year, so expect questions on misinformation, political influence, and even how children are affected by the content. Now, even with a TikTok ban on government devices coming up in the US, President Biden did appear in a TikTok with Niall Horan for St. Patrick's Day.
Happy St. Patrick's Day.
Happy St. Patrick's Day.
But anyway, you have this backdrop of strained relations between the US and China on tech, and that will loom the largest over all the proceedings. Startups are reeling from SVB's collapse. Almost half of all VC-backed companies banked with the California-based lender. Well, joining me now with more on the outlook for venture capital is Samir Kaur, founding partner and managing director of Khosla Ventures. Thank you so much for joining me this morning. So I first want to get where you are in terms of when you first heard the news about SVB, and all the fallout from it versus where you are now that you have the Fed coming in with this backstop.
Well, first, Rochelle, thank you for having me today. It's a pleasure to be on your show. So things have changed pretty rapidly. So when we first started to hear rumblings of the news on Thursday, we immediately went to our companies and, we have hundreds of companies and we talked to them and we asked them, a number of questions. So how many of you bank with Silicon Valley Bank? How many of you have your money with Silicon Valley Bank? Do you have all your money with the bank? And if for whatever reason you're unable to access your funds, how many payrolls would you need help with, and what would that number be? And so, basically from Thursday through Friday, that was our entire focus because companies needed to start moving money on Monday to their payroll providers to make payroll on the following Wednesday.
Now, this isn't something that we necessarily saw a lot of venture capitalists doing. Why make that decision then to really support the funds in this way?
We didn't really have a long debate about it. The immediate instinct was, we've got a lot of these companies and a lot of these CEOs that need us. And, one of the things that we're proud of is we try not to call ourselves venture capitalists. We've always been branded as venture assistants. And so we kind of, the whole firm leapt into action and spent probably about 100 hours on number of calls with our portfolio companies, CEOs, CFOs, et cetera, trying to really get a handle on what was the order of magnitude of money, order of magnitude of payroll that was going to be missed if the FDIC didn't guarantee deposits.
And how is this shaping the VC landscape at the moment? We know obviously SVB was really into some of these very early startups, perhaps ones that wouldn't necessarily have gotten a chance from other banks. Talk about that sort of intertwining and what this is doing for the VC space.
Well, I think the shakeout we'll really see in the next 3 to 6 months. Right now, SVB is probably one of the safest banks on the planet to bank with. They've got all their deposits are guaranteed. I think one of the things that's really important to talk about, though, is that these regional banks, these banks that specialize in certain industries, are very important for the base of the U.S. economy, which is understanding their customers. And so the hope is that once this shakes out, that these banks that cater to startups and entrepreneurs across the country will be there, and ideally there'll be more than one, because one of the things that we did learn is having diversity. Having multiple banks for these startups to call upon would be great.
And Samir, as we look at some of the companies that you've invested in, Block, Affirm, Stripe, DoorDash, Instacart, Impossible Foods, you do seem to be on the cutting edge of some of these next generation
innovations. And of course, also with ChatGPT, you were one of the first venture investors in OpenAI. Does this diminish perhaps your strategy or your intent when it comes to investing in some of these the ones that perhaps might need a little more help that aren't necessarily proven at the initial time?
No, not at all. SVB, plays a critical role in the entrepreneurial ecosystem of this country, but the level of innovation hasn't stopped at all. There are really exciting companies across all industries, and especially you mentioned OpenAI, where we were the first venture investor in that company. That has led to a lot of excitement in the generative AI space. We've always been at the forefront of sustainability and renewable energy investing, and we're seeing lots of activity there as well. So that activity hasn't slowed down at all. The bank provides a lot of services, but in terms of the entrepreneurial ecosystem, that's as vibrant as ever.
And so for some of these startups who are wondering, should they just sort of gravitate towards some of these big banks or perhaps go to angel investing or something else, what would you tell the startup community about this period that we're in right now? Because obviously, as you said, it's still expecting some of these ramifications to last for at least some foreseeable months.
Well, just to clarify, angel investors and banks are very different. The banks weren't, Silicon Valley Bank wasn't, traditionally the primary investor in a lot of these companies. They were the banking partner. They held their deposits. Sometimes they lent them money, but they weren't the investors for the most part. They were the primary investors. So angel investors isn't an option. I think that what we've always told our companies and what we told our companies in the heat of the moment was that regardless of the situation, you always want to have 3 months liquidity minimum at multiple banking institutions, just in case the unthinkable happens. And the unthinkable happened in the last 10 days. So that's been our advice. So whether it's regional banks or some of the larger banks, I think you want to have diversity in your asset holdings. And I think that's the answer that you want.
And certainly there's a wake-up call for that, indeed, for a lot of these companies that weren't diversified enough in that. A big thank you there to Khosla Ventures founding partner Samir Kaul for joining me this morning.
Thank you.
All right, coming up, a new virtual tutor and classroom assistant using OpenAI. But is this the kind of advanced tech good for students? We discuss next. Non-profit organization Khan Academy has wide eyes for the future of artificial intelligence. It's testing a new virtual tutor and classroom assistant using OpenAI's latest education technology. Now, this comes as schools across the country voice their concerns on AI in the classroom. Cities like New York, Los Angeles, and Seattle have moved to ban ChatGPT in the classroom, and universities in India and France took the same measures. Let's bring in Khan Academy founder and CEO Sal Khan to discuss this. Good to see you here today, Sal. So you seem to be taking a very different approach from a lot of the critics that we've seen out there about having ChatGPT and its use in schools. Talk about your role in this and how you're really viewing how this could be used in your classrooms.
Yeah, a lot of these school districts and systems banned it on the premise that students will be able to cheat in an untrackable way. And to some degree, that's not false. We've actually been working with OpenAI for about 6 months now. It feels great to not be an NDA anymore, so I can talk about what we've been up to. So well before ChatGPT came out, and we immediately saw with the GPT-4 technology that it's more nuanced, it's better at math, that we could actually make it so it's not helping students to cheat, but it's actually just helping students to learn, to be as a tutor, to do novel activities. And so when we launched Conmigo, which we're rolling out, there's a waiting list for it right now, as part of the GPT-4 launch last week, we've actually been doing demos with some of the very same school districts that you just listed that banned ChatGPT. And their response has been, this is exactly what we wanted, because we're showing them that, hey, instead of writing the paper for the student, it can write the paper with the student. And the teachers and the student and the parents can have oversight over what's actually going. They can actually see the transcripts, that it can act as a tutor. This has been a bit of a holy grail in ed tech for a very, very long time. And even after the pandemic, a lot of folks have talked about how do you get tutoring to help kids with all of the pandemic learning loss. And so when we showed this to school districts, I'm doing 3 or 4 demos to district leaders almost every day, they're saying, oh, wow, this actually threads the needle for us, because we realize there's a lot of benefit, but this mitigates the risks.
And it's interesting because a lot of people think of this as support for students, but also for teachers as well. We saw how strained a lot of public schools were, especially amid the pandemic. Talk about that aspect.
Yeah, at Khan Academy, we've always positioned ourselves as we want to be every student on the planet's tutor, accessible, and for every teacher. We don't view this as a replacement for the teacher. We view this as an assistant for the teacher. I think every teacher would love to personalize things for their students more, to give every student more attention, or to have essentially a teaching assistant or many teaching assistants in their classroom. And this is what that does. The average teacher spends almost half of their time, 30, 40, 50% of their time, doing things like lesson plans, grading papers, et cetera. This technology, there's older technology that could do some of this, but this technology really starts to be able to help teachers develop lesson plans, not in hours, but in seconds, minutes, allows teachers to get assessment in ways and get grade things that weren't gradable before, like free response and essays. So a lot of what we're launching with Conmigo are actually teacher-facing tools. A lot of times teachers are the secondary thought. We would definitely want to put the teachers first in this, because we think it's important. One, if they save more time, it's more time that they can spend with the student, and also the more that the trust that they have in these types of technologies, the more likely that kids are going to be able to leverage them.
And obviously with every advance that comes with AI, a lot of people sort of look ahead and think what's next, not just for where AI can take us, but also some of the dangers. We know Bill Gates recently spoke about that in an op-ed, and we know that he has donated, the Gates Foundation has donated to Khan Academy. Talk about that dichotomy of sort of wanting to push the boundaries with AI and what we can do, and sort of really managing some of the risks that also come with it.
Yeah, the primary risks are it can make up facts. The hallucination is literally the technical term for when these large language models do that. Historically, large language models have not been good at mathematics. There's always been a fear that maybe it could introduce some form of bias. And these are all real risks. And what we're doing is trying to minimize them as much as possible. GPT-4 does a lot less of, let's call it, the hallucination behavior than what you saw in previous generations. On the math side, it's a lot better. And we're doing a lot of things on the Khan Academy side where we are able to improve the math accuracy and be able to have it act as a nuanced tutor in ways that you couldn't do previously with large language models. In terms of bias, in terms of students maybe trying to do things that are inappropriate, this is where we have a very strong moderation filter. Teachers, parents can monitor what students are doing. And if the students get into a particularly unproductive or even potentially dangerous conversation, it immediately flags the teachers and parents. So these are the types of safeguards that, once again, when we're showing these school districts, we're showing teachers, they're saying, wow, this is exactly what we need, because 40% of all teachers are already using ChatGPT. So it's not like, despite the bans, folks aren't using it. And these are the teachers who are using it. But they just wanted safeguards. They wanted to be more pedagogically positive, not just something that just gives answers. And, we're able to introduce novel activities that didn't exist before, like students being able to interview historical characters or literary characters, or being able to get into a debate and fine-tune their arguments on things that you traditionally couldn't have done with EdTech.
So then when you think about the classrooms of the future and where we are now, just as we're looking at ChatGPT 4, which is already leaps and bounds of what we saw with ChatGPT 3.5, how do you see the future of classrooms looking?
Yeah, it's really an extension of what we've always been preaching here at Khan Academy. The future would be kids able to learn at their own time and pace, real student-centered learning. I always say the best education for most of human history was to have a tutor who caters their education to what you need. If you haven't mastered a concept, they'll slow down. If you find something easy, they're going to speed up. Industrial Revolution, we had mass public education. It was a great thing, but we had to make compromises. We batched students together. We moved them lockstep. I think the classroom of the future is going to be what Alexander the Great had with Aristotle, but you're going to have that for all 30 students in the classroom, where they're going to leverage Conmigo, they're going to leverage other tools that Khan Academy has to learn at their own time and pace, but then the teacher is still in control, but the teacher isn't lecturing anymore. The teacher is able to use the information, they're able to talk to the artificial intelligence. What are my students up to? What do you suggest I could work with them on? Just what a good teaching assistant would do. And then they could do a Socratic dialogue, a game, a simulation. They could go sit next to 5 students and do a more focused intervention, or maybe motivate them, while the other 20 or 25 students are able to continue to work for the next 10 or 15 minutes with the artificial intelligence with Khan Academy. Things that I thought weren't going to happen for 20 or 30 years, I think are going to happen in the next 5 years. We're already working on ways that the artificial intelligence can have a more persistent memory, so it can start to understand what's going to help the students more over longer periods of time. We're making it ways for the teacher to be able to have conversations with the artificial intelligence about what the students are up to. Similarly, for the parents to have conversations with them. Ways for the artificial intelligence to actually moderate conversations amongst the human beings. You can imagine a teacher, and I hope to have this in place in the next year, where a teacher says, hey, artificial intelligence, hey, Conmigo, I want you to break up my class of 30 into groups of 2 or 3, and I want you to moderate a conversation with every group of 2 or 3, have them debate an issue, have them brainstorm something, have them come to their own conclusions, and then you're just going to report back to me, the teacher. You, Conmigo, the AI, are going to report back to me, the teacher, of what have the students been up to? What are some of the stronger arguments? What students have been struggling? And I think this will make every teacher's job that much more fun.
I can imagine that also being translated to news anchors, moderating panels and doing interviews. The future's looking very interesting indeed. A big thank you there. Khan Academy founder and CEO Sal Khan, thank you for your time this morning.
Thank you.
All right, coming up, we check in on the markets ahead of the noon hour and get you set for the rest of the trading day. Stick around. Let's get you caught up ahead of the noon hour. NVIDIA's founder and CEO Jensen Huang joins the program later today to discuss the company's chip sales and growth outlook amid this defining moment for AI. You won't want to miss it. All right, let's give you a final check of the markets before we leave for this morning. As we see here, still a mixed picture here, although at least the Nasdaq coming up a little bit more, but the Dow, they're still just relatively in the negative. They're down about 30 points on the day. The S&P 500 there, just barely positive, though, up about 2 points as we await from what we hear from the Fed and its rate hike decision. Obviously, a lot of mixed ideas about what that means, but what the Fed will do, whether it pauses or hikes by 25 basis points. Widely expected a 25 basis point hike. Right, that'll do it for now. I'm Rochelle Akutho. Please stay tuned to Yahoo Finance.